Hey everybody, happy Friday. Fridays I've found are typically more casual days. I mean, they've been relatively uneventful in the markets. Today was no different. I didn't expect a whole lot out of OPEX today. I've found OPEXs are typically remarkably anticlimactic because you see a lot of it happen, in the morning before the market even opens. So I think what a lot of people sort of look past is that actually sort of the OPEX tailored action really happens the day before and in the overnight session. And I think today, we kind of saw that. We kind of saw that evinced with, of course, the sub 4100 close yesterday, um, the tag of 4050 pre market that was defended. Just kind of a brief little aside to discuss the OPEX dynamics. In my experience, some people may have a different perspective on it. But I know for me, I have not, people think like, oh my God, they see the headline notional $1.8 trillion or whatever the amount of options expiring today. And they're like, oh, wow. I think there's going to be all these super crazy volatile swings. It's really almost never the case. So give me 30 seconds, guys. I'm so sorry. I'm actually just going to fill up my glass of water before we get started. I'm still a little bit under the weather. Throat pretty scratchy. It's weird. By the way, Max, I invited you up to speak a couple times, so I'm going to invite you again. Um, what was I going to say? Oh yeah, like I made a couple comments on it this week. It was 70 degrees here at home yesterday, and now it's 35. So just very odd weather fluctuations. But anyway, so pardon me, guys, for like 30 seconds. Oh, I see we've got Joe Carlos here. Joe, I'd love to get you up if you've got time. I mean, I don't have to, you don't have to sit here for my opening thoughts. I can just get you up if you want to come speak. Because it's Friday, Friday is typically a more casual day. Imagine, today's episode of Market Talk like jean day at the office and everybody's wearing jeans. We typically don't run huge episodes, but anyways, all right, let's go ahead and get into it, guys. So, hope you all are having a good day. Hope you guys have good weekend plans and all that great stuff. I know for me, I'm just going to be relaxing and kind of getting prepped for next week, which I think is going to be a lot more exciting. Um, I guess I'll get into it. I'll talk. I mean, as you all know, I like to. I like to talk macro. Like to talk equities. I'll say this to start off. We saw a ton of strength from crypto again today, which I think is really interesting. But to spend a little more time discussing OPEX dynamics and how it relates to the market and directionally where I think we sort of are. I thought it was very interesting because in our Because Bitcoin Discord, some people in the chat were sort of lamenting, oh, market's bouncing, where's the breakdown, this and that. And I was taking a look at things and I said to myself, man, looking at things here, there was every tailwind for a recovery day. And a lot of these macro signals were really supportive of a risk-led green day across the market. Well, why do I say that? What signals am I talking about? You all hear me get up all the time, and really a crux of my quote unquote bear case on a higher time frame and what causes the breakdown in large part is what we're seeing in the yield divergence. Now I won't rehash it, but just to quickly brush over it, right? We have U.S. Treasuries that have been selling on, across all maturities and durations, bills, notes, bonds. You've seen stagnation and recently some more pronounced weakness in corporate bonds, junk bonds, IG, sub IG, whatever. I mean, bonds have been selling globally for different reasons. Now, you had a huge, not maybe not huge, but you had a fairly sizable intraday reversal that we saw market wide with U.S. Treasuries, corporate bonds. You saw it all. They were down pre-market. TLT was down pretty big pre-market. Went red to green. DXY tapped the 200 daily moving average, rejects off it. I'm not sure when forex markets close, what time constitutes daily close, but certainly when the U.S. equity markets closed, here about half an hour ago, we saw the DXY down 15-20 cents from 104. It was 104.7 in the early morning hours. So, I see something like that. And then we've also got crypto ripping. And my inference is, wow, okay, there's some real relative weakness here in the equity markets, right? You would think on a day like this, hey, you've got the tailwinds for a risk-led bounce. Do they go attack these 4,100 puts? Do they maybe shoot it much higher? Do they maybe go take back everything and make a bullish assertion here from a sentimental, fundamental, and technical standpoint heading into next week? And we didn't get that. I going into the close, I just saw a bunch of algorithms trading against each other, ping ponging around from 4,065 to 4,080. Despite, as I said, a big reversal in bonds and the dollar today. So I thought that was interesting. And again, we had crypto as sort of a risk proxy, really putting in a move, showing a lot of strength. Bitcoin was temporarily above 25K again today. Did not set a higher high, if I'm not mistaken. So, but nonetheless, came back into that 25K level. It's, as I just checked, it was a little under 24.8. Not sure where it is right now, but I checked about 5 minutes ago before I shared my opening thoughts. So, for me heading into next week, you guys know where I stand. It's the interesting thing with market talk. It sort of turns into a narration thing. And I like to talk macro. I like to talk signals. I like to talk equities. On a day like today, I'm not sure. You got a super low volume day, OPEX day, a lot of shenanigans, a lot of shenanigans going on, a lot of games being played. But a day and a week that I interpret as a win for me, with a higher time frame, bear bias, and trying to situate day-to-day happenings and how they comport with my higher time frame expectations. I think this week, certainly the latter half, was a good start for things to get rolling here. You saw the VIX get pinned a couple cents above 20, which I think is constructive as well. So a lot of the 20 puts expiring worthless. Now, this is just a MOPEX, the monthly OPEX. We'll see what the quarterly looks like. But, ultimately, I think the needles moved in the way that they needed to. As you all know, I'm pretty skeptical of sustained upside from here. I'll tell you, though, a wrench not a wrench per se, but an unknown variable, I think, here is crypto. And so the question we have to ask ourselves is, do we start to see some separation? There's just no denying of the upside move that we've seen, and Bitcoin and a lot of the altcoins as well. Bitcoin has really outperformed these last couple of days. You've got the ETH BTC pair dropping just a tad. It's not getting crushed. Just kind of hanging out in the middle of its very high time frame range, where it's been compressing for, golly, a year and a half now, somewhere around there. But maybe 2 years. But I don't have a ton. I don't have. I don't have. You all know where I stand on things, and this continues to be a patience game, and it's been difficult to see through high time frame trades. Even though here to close the week, obviously things really got moving in a constructive manner in ways that I kind of anticipated, and to me, my outcome of today is frankly a pretty bearish one, because as I said, you've got a day where the DXY rejects pretty hard off the 200 daily moving average. You've got bonds reversing and catching a bid intraday, even though really low volume across all markets. And it's just that you see a 30-point float up from the algos on the SPX. Today was one of the lowest volume days of the month. And despite all this, NASDAQ closes down 65, 70 bips, somewhere right around there. So I don't view today as a particularly constructive indicator. If you want to continue to be bullish here, could I be wrong? Well, hell yeah, I could be wrong, but I'm certainly not positioned to be wrong. I'm positioned pretty aggressively to be right. So that's it. In terms of my opening thoughts, I don't like to ramble when I feel like I don't have a lot of new things to discuss or new information to kind of unpack. We're actually working pretty actively here to. We'd like to get some new guests on in the macro space and the FinTwit space. Sent a message to Elliott Capital earlier. a guy who I think's got a great account. So some other guys we're trying to get on, and we'd like to do some more interview styles kind of moving forward, because I don't want to just sit up here and bluster about, hey, yields did this today, the dollar did this, I'm bearish, right? If you're a regular listener of Market Talk, there's nothing I can say that you haven't heard me say 100 times before. And so I'm really trying to avoid that redundancy. And we like to have guests on. We get great people up when we can, but of course, a lot of these guys are working full time. Some of the more public guys, our friend Joe Carlos here is an attorney, of course, so he's quite busy. We get guys like Michael Cantrop every now and then, RJR Capital, but ultimately, almost all of our featured guests, have a primary occupation that limits their ability to come, especially at this time of day, to come up on a space. So we're really grateful to those guys for when they do take the time, because so much value provided, so much great information, and so much great content. So nothing but respect and admiration for those guys. Our friend Joe, especially, one of the absolute favorites of the community. Joe, we'd love to get you up. I know you're busy, but I sent you the message. I see you in here listening. Obviously, I'm gonna invite you to speak again. But so feel free to come up if you'd like. But um, yeah. So that's really all I have to say for my opening thoughts. I'll tell you this: we're gonna go to Max, and we're gonna hear some of his thoughts. He's been handling a lot of stuff on the business end for Because Bitcoin. So I've been doing a lot of great stuff behind the scenes lately. But I'll say this before we go to Max. Guys, if you've got a question to our listeners, because I know not everyone likes to come speak, if there's a question that you'd like to have discussed by me or Max or both of us, or maybe if Joe comes up here, just shoot us a message. Just shoot us a DM. And if there's anything you'd like to talk about, I'm happy to go through them if you don't want to come speak. Um, And so, yeah, anything that's on your all's mind that you'd like to hear discussed on today's episode, we're happy to answer it if you just send us a DM. And so, with that said, anyways, Max, tell me what's going on, man. How are you?
Yeah, hey Carter, I'm great, man. I'm excited that the week is over. Like you mentioned, I was a little less active in the markets as a participant and even a little bit as an observer. Really, kind of all this week, I've been pretty busy with some of the back end operations with Because Bitcoin, working on a lot of stuff right now. But I'll start with crypto. Look, here's the thing. Crypto is pushing its range highs right now, and I think that it looks really strong. I think it's just as likely that Bitcoin trades back at 22.3 as it does 27.3. I don't really know. I can see a really strong case made for both. There's $100 billion of liquidity resting basically right above range highs, so somewhere between 25 and a half and 27. That liquidity will continually act as a magnet for price, both up and down. And right now, it's heavily skewed, with again 9 figures of liquidations and liquidity basically resting right above us. I would imagine that in the short term, if we do break out of range highs, and we push through 25.3, I would imagine that probably 27 to 28.5 is at least a short-term cap on our upside. That doesn't mean we can't eventually move higher, but I think that would probably be a good place to de-risk, especially if you're riding long from lower levels. But some people don't view their Bitcoin like that. For me, I probably won't ever sell all of my Bitcoin. Um, and if it weren't for the potential TLT TMF trade that's setting up for this year, I probably wouldn't. But I think the money's probably best suited in another asset just for a very short period of time. So I think I could see it just as likely breaking out here. But we know that 25K is going to be a battle. With that said, it's never a bad day when you see Bitcoin, in a way, decoupling from equities. It shouldn't trade like equities, and it has for a long time. So it's great to see some red across the board in equities, while Bitcoin really just kind of ignores it. So happy to see that. What am I thinking in equities? Well, we know that 4,100 is probably the most important level on the chart, or at least that's my opinion. I'm going to drop in a little visual in the nest for those that are interested. So I didn't really provide much commentary on this. I just said, "Oh," and that's just kind of like what popped into my head when I charted it and I posted the tweet. And I literally said to myself, I was like, "Oh, all right, okay, oh." So I was lazy about it. I just put that there. But for those that want a visual, it's in the nest. Um, this was originally posted on February 7th, and basically 4100 is our range high on SPX. And the big question is this a sustained breakout of a range, or are we going to deviate, basically sort of swing fail underneath 4100 after a failed breakout? And if we lose that level, then there's quite a bit of error right beneath us, just from a technical perspective. Some people like TA, some don't. I think it can be pretty useful at times. So that 4100 level is so key, and you can obviously you can see that we had quite the deviation above it, and our prices re-entered it, and we actually did close the week back underneath 4100. I believe we closed at like 4080. So right now, I have to lean bearish on equities. I really do, just given the technical setup and given that clean close underneath 4100. What I would like to see early next week for some bear continuation would be probably a Tuesday spike. There's a little bit of a gap that needs to be filled above us. Again, I'm just talking about the technicals now. Um, I would like to see that gap filled. That gap goes all the way to 4090. I'd love to see a Tuesday when the market opens. I'd love to see a spike up to 4090 or 4100. And then I'd like to see some sell pressure come in, and we probably spend the rest of the week trending lower. I would like to see us get under 4,000 next week. But I think there's this useful strategy of if we pump or dump off of a weekly, daily, monthly, quarterly, whatever open, typically you can fade that direction, and you'll end up getting some price action on the opposite side of that opening price. So for the bears, I think you want to see that gap fill early next week, and then probably fire down with some conviction. Will it happen? I don't know. Just coming up with a plan and talking out loud. So nothing to get too excited about yet. Either way, we're really at a bit of a fork in the road. But for equities, I have to lean slightly bearish given the weekly close under 4,100, which is a key level. You have to imagine that anybody that bought the S&P 500 basically over 4,100, it's a really awesome opportunity for bears to make those people puke. That's kind of how you have to think of it. If you're winning and you're making money, you're taking somebody else's money. So who's the most vulnerable party as of this week? Well, right now I see the bulls that started buying SPX above 4,100. I see them as the most vulnerable party that is potentially destined to puke. So to put the hurt on them, I think, again, we'd want to see a little bit of a spike up early next week and probably some continuation down below 4,000. And then from there, we can reassess. In crypto, it's a different story, and I'm thankful for it being a different story. I truthfully hate when these asset classes decide to sync up. But Bitcoin in the short term, I think the pain probably is max pain is still up on Bitcoin. I think that there's a lot of people that are overly for good reason. I mean, it's for the past over a year, it's been pretty easy to just wait for these key levels and just step in front of it and short, and it just nukes every single time. But there's a lot of people that are very interested in trying to short this thing, and you have to just be patient. Because, I mean, a perfect example of this is last time we were at 25,000 back in August. If you go to like somewhere between like the 6-hour and 12-hour chart, you'll see how many times we wicked above the previous wick. So like, let me look at like, I don't know if I'm not going to count them on here, but like you go and look at some of these medium time frames and you can see how this distribution last time we were at 25 took place. And if you were early to short the first quote unquote breakdown or perceived breakdown, how you were just targeted multiple times. It looks like 4 to 5 times here before, maybe even 6, depending on how you want to count it, before we actually pulled back, and we ended up setting new local lows or basically going back to range lows. And I think at a minimum, that's what you're going to see here. If you have your stop right above the previous high of 25.2 or 25.3, whatever we hit, I think you're going to be targeted. I think that's a really easy level for them to take your money. Again, who's the most vulnerable party? So I don't know if we break up from here. I don't know if we just like soar right here to 28. Quite frankly, I would like for that to happen. One, because I own a bunch of Bitcoin. And two, I think we're we're probably destined to get there. It feels like, and I'd like to just get it out of the way. Because it's acting as a bit of a magnet, which is okay in the short term. But let's rip the Band-Aid off. Let's just send it there. But if you're trying to short this thing too early, you're just going to get stopped and stopped and stopped. I mean, if you have a really wide invalidation, like I know there's still some people out there that think Bitcoin's going to 12,000 or 10,000. If you actually think that, and you're waiting for a short, and you're like, you know what, I'm okay shorting here. Well, you better put your stop at like 33 or something like that, just to make sure you're safe. Because if we get some sort of like crazy liquidation candle, you don't know what that slippage is going to look like, and you don't know where that wick's going to take you. But look, if you think if you think there's a decent chance that we head up to or head down, to 12 or 10,000, yeah, I mean, you could hit a 2-to-1 trade right here, no question. You could short right here with a invalidation at 32,000 and a TP of 10,000, and you make it 2-to-1. But I'm saying if you're working with some tighter invalidations, you better be careful here. I've seen this type of price action before, and it's predatory, and you're going to get stopped out if you're continually putting your stop losses and invalidations above the high in this environment. You're going to get smoked. One more thing to point out is this environment is very conducive to altcoins running. For those that play altcoins, you can really hit an awesome trade on some alts. So in the meantime, just ride the wave. I'm not interested in buying here. I would never encourage anybody to necessarily enter the market with fresh capital here at 24/7. But with that said, I'm not super interested in selling or exiting the market at 24/7 either. I think this is sort of a time where, unless you're a scalper or day trader, you just sort of wait, and you can potentially unload or look to exit positions from lower, whether spot or leverage, maybe at like 26.5 to 28, or maybe wait for some sort of pullback into the teens, because I do think that flush is coming eventually. That flush that makes everybody think it's completely over, where we go back to like 19.9, and then suddenly we get like our dead cat bounce from there, and then we'll see what happens. So I think you want to do business a couple $1,000s above us, and probably like $4,000 to $5,000 below us. I don't know if I said that correctly. I'm a little tired. You want to do business a few $1,000s above us and potentially $4,000 to $5,000 below us. This is kind of in the middle for me, but I do like what I'm saying.
Hey, Max, I'm sorry to cut you off. I actually want to, I want to call out, in a friendly and and congenial way. I see this guy Michael Green here in the audience, who's one of the best accounts on FinTwit here, in my opinion. Guy talks macro, talks research, talks data. He might just be here listening, but Michael, I've actually invited you up here to speak. If you're not familiar with us, I'm Carter. I'm the host of Market Talk, and we just like to talk macro, talk equities, talk data, similar to kind of how you do. I've listened to your spaces pretty regularly as well, but can't really discuss it in quite the detail that you can. So, man, I just sent you an invite. We'd love to get you up here if you've got the time. Big fan of yours, and really thankful and appreciative of the value that you bring here to Twitter. So just sorry to cut you off, Max, but just wanted to extend that invitation.
No, you're good. I was wrapping up anyways. Yeah, I'm slightly bearish leaning on SPX in the meantime, and slightly bullish leaning on crypto, which is funny to say, but yeah, that's really just kind of my opening thoughts there.
Yeah, good stuff. Good stuff. And Michael, I'm just seeing the message you sent us. Thank you, man. Appreciate that. It totally comes from a place of sincerity. Like I said, I check out your spaces, pretty much every one that you run. So you and Special Situations are probably my two favorite people to listen to. So you had a great space on the labor market. This was probably 3 or 4 weeks ago, and I really liked that one. That was really informative. We share your stuff in our community. So yeah, thanks for, you're welcome to come speak. Like I said, I'm sure you're busy, so no worries, but open invitation. But anyways, yeah, Max, to kind of get back and to kind of get back to some of the things you were bringing up, I do think it's an incredibly interesting dichotomy. I for one, am a bit surprised to see where you've got the outer edges of the risk curve really moving today and moving, even like you have a day like yesterday, we've got a little frenzied move intraday, Bitcoin 25.2, SPX bounces 35, 40 points. Everyone's, certainly the bears or most of them, not me, but, get the sense of dread washes over you and you're like, wow, they're going to take this higher, 4,200 plus, yada, yada. Look at Bitcoin. This thing's getting ready to beeline to 28K. And then, that's not what materialized, but then within 6 hours, Bitcoin's dumped 16, 1,700 bucks and you have it right back now tapping 25K while the NASDAQ sells off. We haven't seen that, we haven't seen this degree of sustained, decorrelation that's now sort of operating not in perpetuity. That's not the correct word, but for a considerable period of time, seemingly, at least a week or two. We've seen BTC really sort of behaving in its own accord, which I find very interesting. If I want to second guess my bear case, not second guess in the phrase that it's become, in the sense that it's become dubious, but second guess it to poke holes in it and try to think about, okay, what could some signals be that I'm wrong? You look at Bitcoin. We got a DM about this, and I'll address the DM and incorporate it into this argument, or not argument, incorporate it into this discussion. You look at Bitcoin showing a lot of strength, immediately recovering. It's almost all of its downside move from yesterday. A lot of speculative fervor in the digital asset space. But then conversely, you've got mega cap tech selling. As a caveat, you do have a lot of the small caps that are staying propped up. You had the Russell as our leader alongside the Dow today, while the S&P and NASDAQ sold. But DXY pulling back, yields coming down a little bit. NASDAQ closes red 65, 70 bips with a down dollar. But meanwhile, you've got crypto continuing to run. And so I want to bring this up now because we got a DM on it. And I'll say again, guys, if you'd like a question that you'd like to hear discussed, please feel free to send us a DM. I'm happy to bring it up. And as I said, I've invited up a couple speakers. So if they're able to come join us, we'd really appreciate that. Our friend Joe Carlos there, a couple other guys, if you'd like to be involved in the conversation, bring up a new topic of discussion, by all means, please do feel free to come join. But we got a DM and someone asked us to discuss the liquidity dynamics that has really dominated recent conversation as a potential explanation for the risk on rally that we've seen here to start the year. And the liquidity injection, of course, comes in part from the money that's left the TGA account and has gone and has acted as a supportive force, in capital markets, but also some of the more direct forms of just, literal QE that we're seeing from the BOC, the bank, the PBOC, the People's Bank of China. And I don't remember the exact metrics, but it's well over $1 trillion that's been directly injected by the PBOC to stimulate markets. And a lot of crypto participants have said for some time, I remember seeing these takes going back, 6, 8, 10, 12 months, that the next bull run, of course, this was said in the heart of down only in 2022, but a lot of dialogue about how the next bull run is going to be led by Asia and Asian countries. And that's where a lot of these new projects seem to be popping up from, coming out of, South Korea, coming out of Thailand, some things in Japan, some crypto enthusiasm in China, certainly a lot of enthusiasm for speculation in China, or at least Chinese citizens, whether they live in China or not, because of course there are some limitations there. But it certainly is an interesting dynamic where, you have, if this is true, well, we've seen the moves here, right? They speak for themselves that we've seen in crypto lately. Bitcoin up, over 50% off its low, up 40, 45% here year to date. A lot of the altcoins putting in huge moves, some real enthusiasm. You've seen a lot of talk about the Asian version of CT, crypto Twitter, that apparently is just buzzing right now, and lots of activity, lots of enthusiasm. Now, that enthusiasm has, of course, trickled into the Western domain of crypto participants and commentators, But I think that enthusiasm has really obviously been bolstered by the fact that prices have just gone up. So given that it doesn't seem there's any Western capital, any fresh Western capital percolating into the crypto space, you do have to ask yourself, where's it coming from? Is it participants who went cash at 60, 50, 40K and they're buying it back and we're going to get some kind of relatively independent run in crypto, kind of regardless of what equities do, as long as equities aren't going, straight down, which admittedly I do think they will fairly soon. Um, or is this new Asian capital? Is this because of some of the stimulus we're seeing in Western countries? You, of course, we got another question about the BOJ. Recent developments, I'll say I don't really know. I know they're bringing in a new governor of the BOJ who I guess ostensibly is a little more hawkish, but I feel like you almost always hear that whenever a new central bank head is posited, is brought forth to be the new head of a central bank. We always hear how they're going to be quote unquote more hawkish. Ultimately, we tend to just get repetition of incredibly accommodative and dovish monetary policy. But in regards to accommodative and dovish monetary policy that we've seen in broader Asia, right? You've seen it in China. I believe at least a couple $1 trillion worth of stimulus dictated by the government, right, to the PBOC. And then, of course, we've had Japan, which left their yield curve unchanged. So not really opening it up to the open market just yet. I believe it's 50 basis points is the 10-year benchmark. So that just means more printing, right, in a higher inflation time. And there were a lot of challenges, especially in December and January. They spent something crazy. I think it was over a 3-month span. It was $140 billion or something to that extent. Please forgive me if I'm wrong on that metric, but it was somewhere around there over like a 2 or 3 month span. Believe the BOJ had to print 140 billion US dollars to support the yield curve benchmark. So I think we probably do have to acknowledge that as probably a very real supportive force, and perhaps a primary culprit, we'll say, for what we've seen in crypto lately. I think especially with the level of activity you've seen in the altcoin space, in my experience, I found it's typically pretty hard to do that unless you have a pretty concentrated effort when you talk about, altcoins that are ripping 300 to 500% in the course of a couple weeks, 2, 3, 4 weeks. In my experience, and from what I've seen, it's pretty difficult to engineer something of that magnitude unless you have some large players that are supportive of a move like that occurring. So is it Asia? Possibly, probably. I think that would probably have to be my response, is possibly, probably. Probably playing a large hand here in this move, because certainly enthusiasm for crypto here in the West seems to be near the lows with the very public collapse of FTX. Michael Saylor regularly gets, for lack of better phrasing, clowned on for a lot of his sound bites. Now he's going to win in the long run, almost certainly, but right, you don't hear BlackRock, Goldman, JP Morgan. You don't hear them coming out and announcing a new crypto arm. Really, they're just coming out and announcing layoffs. So we're in that phase in the business cycle where a lot of these companies and financial institutions are sort of downsizing, tightening their belts, reducing headcount, reducing capex, trying to tighten their general operational efficiency. And then meanwhile, as we now grapple with the prospects of a more hawkish monetary policy for a longer period of time. But then conversely, you've got some of these Asian countries that had longer than expected COVID lockdown, certainly longer than the Western countries, demographic issues. And so what we're seeing, at least in my interpretation, is these countries just applying direct monetary stimulus to try and stimulate the economy and financial markets. So it's an interesting topic to discuss and pontificate on. For me, I apologize if anything I said was ill-informed. I'm doing my best here. I think I'm in the ballpark. Of course, most definitely not an expert on continental Asian monetary policy, but I think, as I said, I think I was fairly close. So we'll go ahead and take a look at.
Hey, Carter, we got George Gammon in here as well. I'd love to hear from him. I don't know if you're available here, George, but I know that a lot of people in here would appreciate your perspective.
Oh, okay. That'd be great. Yeah, I mean, we don't have any speaker requests. We've got some great people here. Yeah, George Gammon, our friend Joe Carlos there just sent us a DM. He's in a deposition, and he just asked. He just advised us to bring you up to speak. So, to George Gammon, I've just invited you to speak. Our Friday spaces are a bit more casual. We didn't have any planned guests today, but George, if you've got the time, we'd love to come hear from you. And so, as I said, I've sent you an invite to speak. You're welcome to join, my man. We've actually got 8 messages here, so I think we've got a lot of. I think we've got a lot of. I think we've got a lot of topics brought up. So we've got the VIX. Let me just look through these guys. Please forgive me. I'm just gonna try to order these in my mind so we can have a fluid dialogue. So we've got a question from Matt, and he asked, "Is the VIX still a good indicator?" Oh, well, never mind. We'll table that for now. Hey, want to give a big welcome up to George Gammon. Hey, George, thank you for joining us, man. You'll have to forgive me. My name's Carter. I'm the host of Market Talk here, Monday through Friday. You'll have to forgive me. I'm not familiar with your
No
background,
problem,
but
Carter.
yeah. Hey, thank you so much for joining us at the recommendation of our friend Joe Carlos.
Yeah,
there.
thanks for having me up. I'm enjoying listening, quite frankly. And I'm not sure I have too much to add. I don't want to occupy too much time. But one thing, you brought up the TGA, and I think that's interesting because I've got a chart of it right in front of me. And going back to in May 22, we had almost $1 trillion in there, about 945, and now we're down to 560. And it's true that if they're spending that into the economy, it's going to increase M2. But what's interesting is if they're actually using that or a lot of that drawdown to pay down the Fed when they're doing QT, with those treasuries that are rolling off their balance sheet, assuming that the majority of the decrease in their balance sheet is treasuries and not mortgage-backed securities, and maybe it's mortgage-backed securities, but that would not actually result, I don't think, in liquidity getting into the system, which therefore could go into potentially something like Bitcoin. And I do think another thing that's interesting to when you're trying to figure out, kind of how this move is increasing, and if it's due to an additional amount of liquidity, is M1 and M2 are actually going down. M2 is going down mostly because M1, there's a huge drawdown in savings, and it seems like that savings is going into T-bills and to money market funds. So I'm not sure if it's coming from that either. And I'm not disagreeing with you. I'm just kind of just throwing this in there, just food for thought. And then as far as the Asian monetary policy, I just wonder what that transfer mechanism is, as far as, the quote unquote liquidity. I don't know how that works over there. I just know that here, if the Fed did quantitative easing as an example, and that was quote unquote easy monetary policy, that might not get into M2. It may. It all depends on who they're buying those treasuries from via the primary dealer banks. But I don't know, just food for thought there. And I'll just leave it at that because I know there's some other people in here that are a heck of a lot smarter than I am. So thanks for the opportunity, and let me know if you have any other questions.
Hey, George. No, that's great, man. I don't, as I kind of alluded to, I don't know the first thing about Asian monetary policy. So I was doing my best to try and
Yeah, neither do
ballpark
I.
answer a question. Yeah, I'm not a source. And I also thank you for clarifying, providing some clarity and specificity on the TGA dynamic, because I don't know much other than money started leaving the TGA when you started to see kind of some disruptions and dislocations in some of the global treasury markets, right? And they've kind of acted as a supportive force. But one comment I have made is that I found it interesting. I've said this several times. It seems like people were really late to the party in regards to noticing the TGA balance dynamic and then pursuantly associating it with as a prospective supportive force for risk assets because, ultimately the balance began depleting in late September. And I didn't hear a peep about it until like mid-January, which is actually when TGA liabilities peaked. So, capital, I want to say it's maybe 120 or 150 billion in TGA liabilities has returned to the account balance.
Yeah.
And I just I'm a bit skeptical of it because nonetheless, you had, like I said, 3 months of TGA depletion, and a lot of mega cap tech was setting at their lows in early January. So, I was a bit cynical about that whole narrative of, hey, new stealth QE. I think my interpretation of QE is it's basically a drug. And I think people will convince themselves that things are stimulative and QE in nature when they're probably not. But again, that's just my wholly speculative opinion, and I know very little about these dynamics.
Yeah, I agree that QE is more psychological because the way I look at it, the treasuries are just as liquid as the bank reserves, at least when they're in the hands of the people, the players in the financial economy. So I never understood kind of, how that would be a quote unquote liquidity injection, other than if it's going directly to like an average Joe, if it's an asset swap between the average Joe and the Fed, then, the average Joe had a treasury. Now he's got cash, then, I could see that. But if you've got like a hedge fund that's got a treasury and now they have cash, I don't know that that's really any more liquidity because they could have taken that treasury and gone straight into repo and just used as collateral and get any type of cash they want to buy stocks or anything like that. But I do think it really has a significant psychological impact for sure. Just going back to the TGA, I mean, there's so many different variables there that it gets really fascinating, in my opinion. But that drawdown, yeah, I don't know that drawdown was stealth QE because again, we don't know why it was drawn down. If it was drawn down to pay off the Fed, then basically that's just part of the Fed's balance sheet reduction, and that's going off to bank reserve heaven, and it's not really impacting the bank reserves that the banking system has, and it's not really impacting M1 or M2 either. So that's pretty much my thoughts there.
Yeah, no, that's great, George. Thank you for that. Again, I know our audience appreciates it. We've got some members of our Discord community who are commenting that this is very insightful, and I agree. I guess I'll ask you for the sort of obligatory.
I'm sorry. One thing I would add that might be you might find interesting is I did a video the other day because I think it's not just with Bitcoin, although I'd like to get your opinion on if Bitcoin being considered a commodity maybe has driven some capital from crypto into Bitcoin because it's maybe perceived as safer. So you do have crypto going up, you have Bitcoin going up to a far greater degree. Do you think that has something to do with Bitcoin being considered a commodity, therefore, kind of maybe the regulation around it may be less onerous moving forward?
Yeah, George, I think to a degree that's definitely why you've seen Bitcoin being sort of an outsized beneficiary here of this run that we've seen. I made a comment before you were in the space is that the ETH BTC pair, which is a pretty standard proxy, as I'm sure you're aware, for kind of the risk appetite within crypto, right? When you see a lot of speculation going on with Ethereum and altcoins, you see the ETH BTC pair start to push. But interestingly, it's actually kind of pulled back here, not crazily, but it has declined marginally over the last few days. And so I think kind of my general thoughts on it on a higher time frame, I think Bitcoin stands to be an outsized beneficiary of whenever the Fed does strike a more accommodative stance, whenever that occurs, along with commodities and metals. You hear a lot of talk about the commodity super cycle or the repricing of precious metals. It's not a domain that I have a lot of insight to, so I don't know. But I know ultimately, if what's coming is the Fed is forced to ultimately just cut rates to zero, begin printing and stimulate, I think that's an area where Bitcoin stands to be a very acute beneficiary. And I do think with some of the regulatory lack of clarity, I really have my opinion on this is twofold. We actually discussed this earlier in the week. My thoughts with regulation are that in the immediate term, you probably won't see sort of institutional participation and like altcoin speculation in a broader risk off environment. But I do think the dynamic that will probably end up materializing when quote unquote regulation is passed in the digital asset space will ultimately act as some sort of green light to speculate on altcoins, whether or not they're designated as securities or whatever this looks like. I mean, for one, you can't stop, as we discussed, you can't stop Asian participants from creating new projects and putting them on decentralized exchanges. But I think similar to when we talk about the concept of like tax laws, okay, well, they're written by very wealthy people who are outsized beneficiaries. So I do think as it pertains to crypto, quote unquote, regulation, from a game theory standpoint, I don't see at this point what the incentive would be to zero out 99.9% of the crypto space. Now, whether an individual feels inclined to participate in said speculation, well, that decision is ultimately theirs to make. But I do not see a world where on a higher time frame, alts are taken out of Western speculation. I think right now there's uncertainty that's probably, driving disproportionately capital to Bitcoin. Right. On a higher time frame, I probably think altcoins get green lighted and we see more speculation than ever. So a bit long-winded, but that's kind of my
great. That's great insight. So it's probably, or it might be, a result of just kind of more risk on lately. I think if we look at the S&P relative to the NASDAQ has gone up a lot more lately, and over the last year or so, it seems that there's a pretty significant correlation between Bitcoin and the NASDAQ. So maybe it's just an expression of the market saying, hey, we think there's going to be a soft landing. We think the Fed is going to pause or pivot sooner than later. And they're going to pause or pivot because of just natural disinflation and the supply side working itself out. And they're seeing a lower probability of a hard landing, in which case, like the GFC or COVID, that those big money players are going to try to find liquidity any way they can, and that's usually by selling gold, or in this case, maybe selling Bitcoin. So I think that that's maybe what you're seeing as far as an expression of the market, just saying, yeah, our base case is that we get a soft landing, maybe not even a recession, and then we do see continued disinflation, and that allows the Fed to pause, and then that's a good environment for risk on. And layered on top of what you're saying, another thing I might throw at you. Last month, we had much higher than expected retail sales, and I tried to really figure that out. And one chart I stumbled across, and it was from the Atlanta Fed, I believe, and they broke down nominal wage increases by age. And just for everyone listening, if you want to check it out, it's atlantafed.org, and this is wage growth tracker. And if you look at the wage increases as a percentage since 2020, and they've got it broken down, age groups 16 to 24, 25 to 54, and 55 plus. The 16 to 24 age group, I mean, their wages have increased just by an incredible amount, and they're still increasing by an average of about 12% per year. So I was kind of thinking through, everyone's got a different inflation rate based on what your monthly expenses are. And not to be condescending or anything, but let's just assume that a lot of the people that are in this age group and this demographic are still living at home. So the rent increases haven't really impacted them. Maybe they don't buy a lot of their own food, so that really hasn't impacted them. But they have a huge increase in their nominal purchasing power, and therefore they may have a big increase in their real purchasing power. And I think when you look at the retail sales, the reason it was so high, one of the two main reasons, was bars and restaurants. And that would lead me to believe that maybe it is this younger demographic. And because their wage increases are so extreme lately, and maybe that plays into crypto and therefore Bitcoin as well. Just again, food for thought.
No, it's great stuff, George. And this has been a dynamic. And I'll just say this briefly. We've had Michael Green join us, so we want to be respectful of his time.
Yeah. Oh, yeah. Yeah. I'd love to hear from Mike.
Introduce him here shortly. Yeah, no, he's awesome. I'll say this. I referenced Special Situations, who I think is one of the absolute just most outstanding accounts here on FinTwit. But he often brings up, I believe he lives in West Palm. And he talks about gas stations that are paying, $27 an hour to ring up people's Gatorades. And I remember it was the last couple summers. My dad's from Michigan, and every summer we go up very far up north in the state of Michigan, and the subways there pay actually $32 an hour, if you can believe it. And I've got a picture way deep in my phone, but you already alluded to it. People live at home. Listen, if you're working 40 hours a week, well, son of a gun, you're making 55, 60 grand a year to make sandwiches.
Yeah.
You're not seeing that level of wage increase in low level corporate sector. I'll say this quickly. Before I began working for Because Bitcoin and trading full time, I worked in consulting for Booz Allen Hamilton. My salary with a really good college resume and all this coming out as a consultant was $72,000, and I got a 6% raise each year. I was making 75,000, and in real terms, I make more now for Because Bitcoin. But I only say this to say you don't make anything your first couple years in the corporate world, whereas now you can go work at a gas station that have had to adjust for a lack of labor. From at least that's my understanding, and you're making as they call it, a living wage working in retail, so it's a really interesting dynamic. But I know Michael Green has a lot of great insights into labor. Michael, thanks for joining us, man. I imagine there was a reason you felt compelled to come join, but by all means, man, please, we'd love to hear your thoughts, and thanks again for coming up. And Michael, you're on mute, by the way, if you were trying to speak.
I knew that. I'm an extremely sophisticated user of this application. I'm joking. I had no idea I was on mute. It's a pleasure to be invited. Glad to be here, guys. George, nice to hear from you again. Can you guys hear me now?
Yep, we hear you great.
Okay. All right. I'm actually just going to post a chart that I put up on my tweet feed into the nest. And, I think it's what George is hitting on, I think is actually an important one. Hopefully that made it in. I think yeah. So the underlying story here is literally it's the supply side dynamics that we've seen everywhere else, right? And those with less than high school degrees, which 16 to 24 is going to be obviously a disproportionate proportion of them. Those who have less than a college degree but more than a high school degree, they've continued to shrink in absolute numbers. There's just fewer of them. You have fewer people who are willing to go work on the poultry line at Purdue. You have fewer people that are willing to sling burgers at McDonald's. You have fewer people that are willing to serve you refreshments at a gas station, right? And as a result, the prices are going up for those. There are also jobs that are quite difficult to automate. How do you set up a automated gas station attendant, right? It's really quite difficult to do in a lot of ways unless you're willing to forego significant quantities of either protection or income. And even there, it becomes really hard. We've known about this stuff for going on 10 years, right? So roughly 10 years ago, Eric Brynjolfsson and I'm blanking, Brian McAfee, I think is his name, published a book called The Race Against the Machines. And it, hypothesized effectively that what we were going to see is a hollowing out of the center. Those who do jobs that we think of today as relatively skilled, whether that's working on an assembly line or, but tend to be staying in place, right? So working on an assembly line, sitting behind a computer and entering in form data, et cetera. Those are increasingly easy to automate. And we have more and more people competing for those jobs. The numbers that I heard just yesterday out of New York City from the technology sector is that they're seeing 3,000 applications for each available job now. It's completely at odds with the data that we're seeing around shortages. All those shortages are happening at the low end. right? It's just this is a low end phenomenon. This labor tightness. It's a function of a lack of immigration and the fact that we basically jammed everybody into college, created conditions for them under which they received degrees that were largely useless. You highlighted that you went to work for a consulting firm with a technology background. There was no indication when you went to college that you were going to be better served by getting a technology or a STEM degree in terms of the pricing, the risk that was put on your student debt, et cetera. None of those signals were available to you as a 17, 18-year-old. And so, most people ended up choosing things like various forms of humanities studies, English degrees, French medieval literature, underwater basket weaving, the list goes on of useless degrees that basically provide you with an excuse to go to the college experience. We're now seeing the comeuppance for that, right? We can't find plumbers, but you've got more than enough opinionated French medieval literature majors that'll tell you what's wrong with the world.
Michael, it's so funny because I was actually a philosophy major. So just as an aside, but I think
as is my oldest son, who is now going to work in finance technology, right? So if you happen to have the right background and the right connections, so that during your summers when you're getting your degree in philosophy, you also should be working at internships and gaining experience in industries of real value, right? Then you're going to end up fine. But your value is created by your work experiences, not by the philosophy degree. And to be fair, philosophy is actually programming for the mind. So I'm not as hostile to that as I am to underwater basket weaving and French medieval literature studies.
Yeah, and then Mike also too, I think that demographic, maybe their largest expense would be student loans. And if I'm not mistaken, those student loans are still under forbearance. I don't think they've had to start paying those back yet. So that may be another factor.
Well, the idea is that they're going to be, we're going to get rid of them. There's no way that's going to happen. The Supreme Court will not allow that. So we're going to have that surprise later this year. But along the same lines, when you actually think about that dynamic, it contributes to components of the gig economy, and even that's starting to break, right? It's one of the reasons why your Uber bills are going up so much, your DoorDash is going up so much, because the traditional model is you didn't have to start paying your student loans until you were employed, right? So you were actually better off from a cash flow standpoint taking a job like an Uber driver or a gig economy job and not paying back your student loans from a cash flow perspective.
Right.
From a wealth perspective, that was a disastrous choice, but we're only now beginning to realize that.
Yeah, I'm just talking about the increase in aggregate demand in addition to their wages going up. If you look at their personal P&L, their revenue's gone up, but their expenses may have gone down significantly as well, which would shed light on that retail sales, and then maybe a lot more capital flowing into crypto and Bitcoin.
Well, the retail sales, just be really careful on that, right? Because there's a huge seasonality component to it. And we had exceptionally warm weather this January. So things like bars and restaurants, obviously people go out more to bars and restaurants when there's warm weather or unexpectedly warm weather. It doesn't appear that was properly adjusted for. Basically, it's explained by heating degree days. But it's, and this is one of the real problems. It's something, George, you and I have talked about, individually. Just our data systems are not set up for this type of disruption. We had finely tuned systems that were designed to minimize the number of revisions that occurred under what's called the Great Moderation. That meant that we tweaked and twisted and pulled the data in all sorts of ways to give it, smoothness. That smoothness is now biting us in the ass. We genuinely don't know what's going on right now.
Yeah. Mike, do you have an opinion on the employment data as far as the household compared to the establishment?
Yeah.
And because I don't want to put words in your mouth, but I believe that you're kind of in the disinflation camp, and you're looking at the bond market as kind of the smart money and saying, okay, well, we might, or we'll most likely get a recession. And it's just what we're seeing in the job market, or the jobs numbers just doesn't really add up if you just look at establishment. I'd love to get your opinion on that.
Yeah, so there's a couple of separate issues that you have to think about, and again, the data is a critical issue, right? So one is the surveys that are conducted. We've seen a collapse in the response rates, and when you see a collapse in the response rates, you run higher and higher risk of bias in responses. So just to give you some idea how stupid the process that we're still pursuing for the household survey is. You only survey people who have landlines. All right. Just
No,
stop and
I
think
didn't.
about that for a second.
Yeah, I didn't know that. That is a big deal, isn't it?
Right. And it's the legacy from a time period in which it cost money to answer a phone call that came in on your cell phone, right? So nobody would answer the cell phone. So they transitioned to, so they exclusively use landline, and they've started to try to transition to some online forms, et cetera, but response rates have fallen by more than 50%. That's true also for the establishment survey, where the data has deteriorated significantly in the post-COVID environment. And one of the assumptions that is made with the COVID data or the post-COVID data is that any business that does not answer its phone or does not respond to the survey basically responds. It is assumed that they are growing like the businesses that do respond. Right? Does anyone see a problem with that assumption? Like maybe you go out of business if you don't respond. And that's just not like we've tried to twist all this stuff to create conditions under which it appears to be smooth. If you look at some of the more esoteric data sets, and they're not particularly esoteric, I'm just saying they're less well followed, full-time jobs have been falling since June, right? That's an important distinction. The unemployment rate for those with college degrees has started ticking up sharply from September. And all of those things, in my opinion, matter because this is a recession that is being driven by the dynamics of what I posted into the chat. This is a college degree, middle management, marketing rep at, marketing manager at Facebook sort of stuff, recession, right? You're seeing Google employees being laid off, not people that are changing bedpans at nursing homes. That's a huge deal in terms of the systems that we have in place for tracking this stuff, right? Just as a quick statistic that I've shared many times, most of you have probably heard something like this at this point. Do you guys know what the median wage, the median compensation package for the people being laid off from Google? This is the median, right? So the 50th percentile.
I saw it was revised, Michael, but I'm not sure I saw a figure. I'd be really interested to hear what it is.
So my understanding is it's about $275,000. So the people that are losing their jobs is like 275 grand. Do you know what the maximum unemployment benefit in the state of California is? The most you can collect for a period of unemployment.
What would it aggregate to, like 30 in Cali, 40,000 a year maximum?
$13,000.
Wow.
Is there any question why
Wow.
people are not bothering to apply for unemployment benefits when they're laid off from Google and they currently have severance? And they have up to a full year to apply in arrears, right? So a year from now, they could say, okay, you know what, I want $13,000 as a lump sum payment. I'm going to go apply for that. Right. The problem that's about to emerge is that those individuals that were making $275,000 are suddenly going to discover that they're not worth anywhere close to $275,000 in the world that goes forward. So their highest compensation exercise is to stay on the severance package from Google. Then they basically are going to sit there and they're going to wait until they can find the $275,000 a year job that doesn't exist, because the minute they go out and take a $150,000 job, they can no longer afford the lifestyle that they were living before, nor can they turn around when they finally do find the job that they were hoping to find and they say, how much were you making at your last job? They can no longer say, I was making $275,000. As a result, the period of unemployment continues to extend. And that's absolutely what we've seen in every recession for the past 40 years, is that the periods of unemployment are growing longer and longer and longer.
Michael, I've got to ask you, a question that I often hunt and actively try and solicit from certain guests because, as our regular audience knows, the two domains as it pertains to loosely financial markets I know absolutely nothing about, but then they're very important ones, are labor and housing. And as I said, I tuned into one of your labor spaces 3-4 weeks ago to try to get some insights. One of my buddies sent it to me, said it was great stuff, and it was. I want to ask you, given the dynamics in the labor market, whereas you've already alluded to, and some of the blue collar stuff, and just anecdotally, experientially, observationally, every time I go to a chain restaurant, every time I go to a retailer, all I see is help wanted.
Yep.
And so I want to ask you, if we see the give out in consumer spending, do you think, which, I mean, if rates stay high, I have to, and inflationary pressures remain elevated, I would have to think eventually the spending gives out once the savings get burned through. I believe you're in the recession of some sort camp. What type of dynamic do you see for the labor market? Because can we have a recession where we see consecutive quarters of 2-3% GDP contraction where unemployment doesn't get above 4.5? What do you think?
So if I look at metrics that you can basically match up against historical dynamics of unemployment as compared to the actual unemployment numbers themselves, things like how many cars are being sold, et cetera, those would suggest that we're headed towards 8% unemployment. I think that's too high because the real story is that we have exceptionally low growth in the labor force. It is growing for those in college, although even that has started to slow down significantly as well. Despite all the complaints about immigration, that's in the toilet as well. We have roughly 10 million fewer immigrants in total than we thought we would have projecting forward from 2008. So this is a big deal in terms of the missing people who have a high propensity to work. In terms of the dynamics of how deep or how bad a recession would be or what you would expect to see, the real question is, in my view, how hard is it? How do people change their behavior once they recognize that $275,000 a year job or the $100,000 a year job is unlikely to return, and yet there's plenty of opportunities on a short-term basis to do jobs that are quote unquote beneath you, right? Do we adjust to that? History suggests we don't, right? It's not like lawyers decide that they're going to become bartenders and bartenders decide that they're going to become, shoe shine boys. It doesn't really work that way. So instead, what you discover is that people find alternate ways of living. You become an incel living with your parents with low aspirations. You don't ever want to get married. You don't want to have kids. You want to play video games, which is much lower cost and basically means that you can be taken care of in a framework that looks a lot like institutionalization in prior generations. That's what it seems like we're headed towards. We're trying to put ourselves at a lower node, right, where the intersection of supply and demand intersects at a lower point. It's a terrible choice, but that's the direction we seem to be heading.
And I mean, how do you think that manifests? Like just one quarter or over the course of 3 to 6 months, we see a stark drop off?
Well, remember what happens. There's two ways that unemployment occurs. There's the way it happens in the 1970s, and there's the way it's likely to happen this time around, right? So the 1970s, the primary source of unemployment was new labor force entrants, people looking for work that couldn't find work, right? Because the Fed was trying to slow inflation. Even as what we really needed to do is exactly what we need to do this time around. We need to invest in growth, right? A really great exercise. I strongly encourage every single person on this call to just Google Truman's State of the Union speech, 1947. Right now, that sounds like a completely obscure reference, but remember in 1947, you had the world was shut down for World War II. We reopened the economy. Demand for consumer goods exploded because people had been effectively prevented from buying them. Demand for services exploded as servicemen returned. and we had 19% inflation. Right, 19% inflation. The solution was build houses, build cars, build consumer goods, add people to the labor force, encourage production, right? And we got inflation down in 18 months without the Fed doing anything on interest rates. What we're doing right now is completely insane.
I'm sorry, Michael. I didn't know if you were.
Yeah, no, that's fine. I mean, what we're doing right now is completely insane. The idea that you're going to hike interest rates and somehow destroy demand, right? Particularly when you consider that there is a sizable fraction of the US population, those in the bottom half of the income strata, who demonstrated clearly to us that they have been underserved and they have not been able to access consumption in a way that they should have been. Remember, these are all the people that got fired because we sent their jobs to China, right? They want to consume more. Quite frankly, they're entitled to consume more, right? It's just the rest of us are not, not being legitimate in our consideration of their needs because we're so busy reveling in our ability to send jobs to India and China and have the product shipped back here with the US government effectively running deficits to finance the consumption at the lower end.
I'll tell you, Michael. We I host Market Talk every day, and this is really phenomenal insights in regard to some of the specificities of the labor market, insights that we have not had shared here on the show. This is really great stuff. Our community is really enjoying this, sending some messages, and I know our audiences as well. I guess I'll ask you, I know you talked about what things like used car prices would, I'll ask you this. When we're talking about, rate hikes as a mechanism to destroy demand, I think it's becoming more clearly evinced on a daily basis that that's not working. But when you see things like credit issuance starting to dry up from like regional and local banks, I have to ask myself, if you see like CapEx, go down a ton, and you start to see trickle down what we've seen in some of the mega caps, is that enough to a 6, 7, 8% unemployment rate when you have, a lack of availability from tradesmen? What do you think? I know you said you're not in the 8% camp, but I'm looking at this wondering how the hell we get to 5 off my very limited understanding. So what takes it higher? Who loses their jobs and why?
Well, so that, as I alluded to before, right, there's two sources of unemployment. There's rapid growth of the labor force, right? And there's people losing their jobs. In the 1970s, we actually had more jobs created than any other decade in US history. Right now, just let that sit for a second. In the 1970s, when the US population was half the size that it is today, the story that you're told is stagflation, a stagnant economy and inflation. And yet we created more jobs in the 1970s than any other decade. That's a fact. You can go look it up. Right? So what we actually had was a situation in which the economy was growing fast, but the labor force was growing even faster. The number of people who wanted to participate in the labor force because of baby boomers, because of women entering the labor force, because of the normalization of minorities in the labor force that was made possible by the Civil Rights Acts of the 1960s. All of those created conditions in which the number of people who wanted to work was rising more rapidly than the opportunities for them to work. And that's hugely inflationary, because when people want to work, what they're really saying is, I want to increase my consumption. Right? If you don't want to increase your consumption, if you're stable where you are, you're going to sit, right? Why not sit on the sofa and enjoy life, right? As compared to getting up and working a 10-hour day. So the reason why you do that is because you want to increase consumption. We decided to respond to the natural increase in prices that comes from that desire to have more. We decided to respond to it by hiking interest rates and trying to kill demand. And guess what we got? We didn't manage to kill demand very much. As you point out, it failed. What we managed to kill was supply, and it had to be met by imports from the rest of the world. This is where the US began its huge trade deficits. Right? We're doing the same thing now. Like, this is insane. If you think about it, we're the world's largest oil producer in an environment of perceived oil scarcity, and we're running record trade deficits. Why? Because we're killing our supply faster than our demand. Right, and you talk about automobiles, for example. I mean, we have 200 million vehicles in the U.S. auto fleet. Actually, no, I'm sorry, it's almost 800 million vehicles in the U.S. auto fleet. We're producing 15 million. Right, like the average car is now expected to, like, that implies that the average car has to last 20 years. Why are used car prices high? Because we have shortages of them. We may see that change, as a number of people have correctly pointed out. Danielle DiMartino Booth and others have been highlighting these dynamics, because in order to obtain transportation in the pandemic, in which suddenly people who had been comfortable living in cities or taking public transportation were forced to confront the reality that the passenger next to them on the public bus could be a death vector for them. Right now, it turns out to have been bullshit, but that's what we believed at the time. So naturally, you rush off to get transportation in the form of private transportation. That means that demand pushes outward while supply is actually restricted because people don't want to sell their cars. Right? So you end up with prices skyrocketing and people taking on debt to obtain access to them, because it's mandatory if you're not living in the city and you can't take public transportation if you want to participate in the economy. And all of a sudden, we're finding that those people are incapable of incapable of paying their bills. Right? We're seeing a rise in defaults on auto loans and repossessions. Right now, eventually that'll resolve to much lower prices, unless, of course, the producers of autos conspire, as you can very clearly read them doing in the newspaper, where Renault announces to Elon Musk that his price cuts in the electric vehicle category are destroying confidence in electric vehicles. Right? Mary Barra, who runs GM, has announced that they are not going to produce to increase inventories. They like high prices and much lower inventories. The exact same language was used by Stellantis. The exact same language was used by Ford. Right? These are very clearly oligoleptic. God, I can't say this word today for some reason. These are oligopolies that are behaving as you would expect them to behave. They want to maintain high margins. You don't see high corporate profit margins in inflation. Right? If it's a true inflation, you don't see high corporate profit margins, because they're trying to hold the line on prices as costs push against them. We're seeing the opposite here. Prices are staying elevated relative to costs. We're seeing real wage declines, right? The 6% wage gains that George was highlighting, those are negative in inflation adjusted terms, right? That is not what happens when there's 2 job openings for every job that's actually available. Another bullshit statistic you're being fed. So, I mean, that was a long diatribe. I'll take a breath and let you say something.
No, not a diatribe at all, Michael. Really outstanding information and exceptional insights, and we thank you for them. I mean, it's one of those things. I guess the only question I kind of can pose is to just ask if perhaps you'd grace us with another diatribe, because I'm not going to lie, man. I know a decent bit about macro, enough to participate in meaningful conversations, and I'm a trader. I can talk markets. I can talk about the dollar and yields from both a macro and technical standpoint. But as it pertains to labor, all I can do is just kind of ask you if, after you catch your breath, if you'll just kind of share whatever else is on your heart. So well, I'll tell you this, like, what's your macro outlook for at a super high level? Do you think we get a meaningful recession? I know, it seems like you think unemployment probably moves up. What do you think in terms of implications for financial markets? Do you think the resolute nature of demand that we've seen here over the last few months, what's it indicative of? I mean, what does it imply? At what point do the corporate earnings slow down? Does CPI remain elevated? Does services inflation remain strong? Do services PMIs remain elevated? Do we see bonds continue to sell because they're still losing in real terms? What do you, just any of these things that stand out to you, by all means, pontificate to your heart's content.
Well, so there's a whole bunch of things there. One is when you say bonds are offering negative real yields and losing money in inflation-adjusted terms. That's improperly comparing time periods, right? So the inflation number you see tells you what happened to prices last year. Bond yields tell you how much interest income you're going to receive next year or however many periods the bond is. So you can't really compare those unless you believe the past perfectly reflects the future. If you look at forward measures of inflation, which can be derived from products like TIPS, Treasury Inflation Protected Securities, those suggest that we have positive real rates to the highest level that we've experienced in a very long time. So, you can debate whether you think the inflation expectations are correct. And if that's the case, then there are different trades that you can make around that. But to argue that bonds offer negative real yields on a look-forward basis, I think is one of the mistakes or one of the errors that's commonly made right now. And by the way, you're not alone in that. Larry Summers, among others, has made similar errors in his calculations. As it relates to, I'm trying to think if there's the other stuff. In terms of earnings, again, it becomes a definitional issue. If you look at GAAP earnings for the S&P, they started falling in March of last year. They're down about 20% in GAAP terms, generally accepted accounting principles, but we no longer pay any attention to those. And candidly, they don't really matter all that much until they're forced to matter by a catalyst like a debt covenant. You're now starting to see the implications of that with a significant rise in defaults that's occurring on a global basis. U.S. property defaults are starting to stack up at an accelerating rate. We've seen industrial companies, Standine, for example, just filed for bankruptcy, a former private equity sponsored entity. So we're starting to see those start to play through as companies are forced to confront paying dramatically higher levels of interest rates. Standine, for example, I think went from a 4.5% coupon to looking in the mid-teens, right? And they just simply couldn't afford it. And there's another wrinkle that hits in 2023 with the tax deductibility of interest that has a double whammy component to it. So you may remember under the Trump tax reforms in 2017, there were limitations on the quantity of interest expense relative to EBITDA that was tax deductible. You were limited to 30% of the EBITDA level as being tax deductible. In other words, if your interest expense was greater than 30% of your EBITDA, it was no longer tax deductible. Give or take doubling and tripling of interest rates have pushed a record number of companies over that threshold. Now, they may choose to suspend it again, but at this point they haven't. That suggests that you're going to see extraordinary distress because the after-tax interest expenses are going to explode for many of these private equity-sponsored companies, as well as many forms of commercial real estate. That should lead to significant stress in the credit market in the look-forward period. If I'm, looking out 6 to 12 months. But markets no longer really discount, and this is where it overlaps with the rest of the stuff that I spend all my time blabbing about, which is the dynamics of passive, right? Nobody at Vanguard cares. Right? There is no analysis that says, boy, I think this company is going to default, despite the fact that the ratings agencies have given it, a single B or a double B. They legitimately don't care. It's just a CUSIP in an index for them. And until it actually encounters a default and a downgrade and gets ejected from the index, they're not going to sell it. So this is why we experience things like 2017, Toys R Us going bankrupt. Their bonds were trading at 103, and the next day they're trading at 20. Right? That's almost a Lehman type event, even though it was extremely well telegraphed. I would argue you're seeing similar dynamics in many spaces today. You've got record tightness in CRE. And many CLO loans have recovered their 22 highs, even as the underlying credit is deteriorated sharply. I mean, these are vacant buildings in many situations that are never going to recover their tenancy. So the idea that they can cover their interest expense, particularly at higher levels, and again, remember things like commercial real estate are almost always floating rate notes, it's just kind of absurd, right? So the way this recession will happen looks a lot more like the recession and the unemployment increase from 2008 or 2002, in which we experienced credit events that caused businesses to unexpectedly fail. And when businesses unexpectedly fail, that means that they leave things like accounts payable unpaid, which ripples down the line of suppliers of businesses that are hurt without expecting to get hurt. So that was a long-winded answer to your fairly straightforward question.
Michael, it was great. I would I would almost contend not long-winded enough, because we're just getting some really outstanding feedback here from our community, and some of the comments. People are really enjoying this. I sent a tweet here in the nest from one of our friends of the brand, Disruptor Stocks, who's a great kind of macro headline guy. I'll ask you this: like, when you talk, and I get it, you talk about some kind of credit event. That's what that phrase in itself, I feel like, has I guess sort of been reduced to this abstraction, where people are like, "What?" And I'm guilty of this as well. People are like, "Well, there's the Fed's hiking; they're going to hike into some credit event." We were probably, I feel like, the closest we neared to it was late September, early October. Of course, the UK gilt market isn't necessarily a credit event, but something of that ilk. So, I guess to ask you, I'm not sure where you stand in sort of the higher for longer camp, your outlook on rates, but I've asked Michael Cantra about this, a couple other macro guests that we have up, somewhat frequently. What causes credit spreads to re-widen? Because is it panic? Is it the Fed? If there's more rate volatility introduced, how do we get from where are we now? Like, the credit spreads are like, what, 450 basis points, something like that, and they peaked out at like 620, 630, somewhere around there in late September, early October. How do you get credit spreads to re-widen and get into some sort of quote unquote credit event that I have no idea what will look like?
Well, so the credit spreads that you're referring to are in the high yield space. There's credit spreads across a variety of indications. The problem with most of those is you can't go back very far, right? So they're very short dated data series. Most of the CDS data series started in 2005 at the earliest. I'm going to try to pull something up here for you that's going to provide a little bit more perspective. Let's see here. I'm going to post this just so you can actually see it. I apologize, for some reason Bloomberg occasionally does not do a great job of letting me put in dates here. So I got to put one more thing here. All right. It's taking its own sweet time here. This is the wonderful part of having been foolish enough to give Elon $8 of my money every month.
No problem, Michael. I'll remind our audience and give them a brief refresher while you pull that up, Michael, that we've been joined by Michael Green, obviously, and he's been providing just some outstanding insights into the labor market, kind of a forward-looking dynamic in regards to credit, a little bit of discussion on rates, and just kind of what the forward-looking outlook is.
What you're looking here in the tweet that I just put into the nest is a picture of credit spreads going back to 1947. This is the spread between the triple B and the double A corporate. It's effectively high grade spreads. It looks almost identical to what you're going to see in high yield or anything else. It's just a question of magnitude, right? So the shape is functionally identical. The point that I would make is that we're actually running a period of relatively elevated credit spreads, period, right? There's clearly some elements of distress that exist in the market today. The question is just, how serious should it be, or how serious should we think about it? And the second thing is, you'll notice that I centered on 1982. That's because what I think we're creating is a situation very much like that, where an unanticipated widening of credit or increase in interest rates is creating its own distress, even as it mechanically compresses credit spreads, at least initially, right? So by raising interest rates, if you think about a investment grade or a high yield bond as a component of the risk-free rate plus a credit spread, as you raise interest rates, you make bonds in aggregate more attractive. And therefore, that tends to lead to some compression in credit spreads. There's a negative correlation between credit spreads and interest rates, risk-free interest rates. The problem is that there's also a positive correlation with a lag, meaning as I hike interest rates, I make it more likely that businesses actually default. And that's the stage of the game that we're at right now, right? So initially, corporations try to avoid borrowing into those conditions, into much higher interest rate conditions. Ideally, they want to wait and be the last to borrow when interest rates are being cut, because like Sandine, they discovered that if they tried to borrow at today's rates, they'd be bankrupt, right? So there's really no point in even trying. You're exercising an option that guarantees your death. So the question is just, do we continue down this path? And if so, then it's almost certain that we're going to see an extraordinary increase in default rates. And that in turn is going to bleed through into fears about loss of principal as compared to the greed and excitement around getting a higher yield. Does that make sense?
No, perfect sense. And I actually think what you ended with is a great segue for me to pose you another question, which is there's like 300 billion. I don't know the exact number, but the amount of corporate debt maturity, there's a bit that's here in the first quarter. It accelerates into the third and fourth quarter, and then some residuals in 24 and 25. What do you think about that dynamic? I know we're starting to see the beginnings of the default rates uptick, and seemingly we don't hear a lot of talk about it. So what do you think about that dynamic moving forward, Michael?
Well, I think I think you hit the nail on the head, right? So it does begin to tick up. A lot of companies, almost every company refinanced in 2020 and 2021 that allow them to push out the maturities. And the very high levels of corporate profitability that we experienced due to exceptionally high levels of consumer spending allowed some companies to reduce their debt loads, although most of them took advantage of the opportunity to pay out dividends to sponsors, et cetera. So there wasn't really a significant improvement in corporate credit quality, and there was a significant deterioration in the quality of covenants and everything else because the demand for effectively lending money under those conditions rose significantly, right? And same framework that you saw leading into the global financial crisis with the excessive lending into the mortgage space. The problem that I would highlight is twofold. One is as the economy deteriorates, and this is a real issue associated with the economy deteriorating, companies that are now experiencing high levels of profitability begin to see that profitability deteriorate, and in some cases it turns to losses. Those losses in turn shorten the quantity or reduce the quantity of cash that they have available to make themselves an ongoing concern and to pay their debt. The usual approach to that would simply be to go to the credit markets and borrow the money, but now if they do that, that credit is incredibly expensive. Right, so a deteriorating economic condition actually accelerates those time periods and that wall of maturities, forcing people into earlier refinancings at the least opportune time. So that I think, unfortunately, is the direction that we're going. Right, like it should be pretty clear. I'm pretty bearish right now. Right, I just I think that we're being fed a bill of goods, and unfortunately, the worst part is that those that are feeding it to us actually believe it themselves.
Michael, one of the things we heard this a lot in the first quarter of last year, because I've often reflected on this in my own limited capacity, because as I said, last year, what did we hear from a lot of macro people? Well, we heard, oh, the Fed can't raise rates because 25% of the 3,000 largest companies in the United States can't afford the interest payment on their debt. And so it's not viable to keep, the United States will have to refinance its debt at exorbitantly higher levels, yada, yada. And I began wondering to myself, I said, well, you know, without delving into anything conspiratorial, not my implication in the slightest, but I ask myself, is this almost healthy from a longer time frame to see some of this washout occur for companies that couldn't be profitable in the most exorbitant period of growth in such a short time frame, 2020 and 21, since at least, probably the end of World War II. It is that potentially a factor, that it's almost sort of a natural selection process playing out in sort of an elongated time frame with elevated rates because some of the stronger companies can handle this. And is this sort of a washout that we may see where you'll probably see some defaults, you'll probably see some bankruptcies, you'll probably see some of the greed naturally eliminated. And from there, we can kind of refresh to a new cycle where people are brought back to principle. Do you think this dynamic is perhaps at play to a degree here?
So that's what I would describe as the German or the Calvinist principle, right? Which is, it's good for us to suffer. We're going to come out of this healthier and stronger, right? There is an element of truth to that, right? That which doesn't kill you makes you stronger. You also don't know in advance whether it's going to kill you, right? And that's really the problem with artificially inducing recessions. Is recessions are by nature violent events that cause the creative destruction of, Joseph Schumpeter, et cetera. But there's never a guarantee that you come out the other side. And in the current environment, I think when the argument is that we need to enter a recession in order to fight inflation, I just think that's such an incredible failure of imagination. We have, just like we did, going into COVID, we had protocols for how you handle respiratory viruses. We ignored them. We have protocols for how you handle supply-driven inflation spikes. We've ignored them in favor of pursuing the last model, the Volcker model, that candidly did not at all do what everybody thought. But it's the story that Jerome Powell has told himself he wants to do, right? He wants to be tough like Tall Paul. I personally think it's a fool's errand, and the data is actually incredibly straightforward, right? If you hike interest rates, you ultimately create inflation. That sounds insane because of the way we were all trained in economics, but it's very straightforward. You're reducing supply far faster than you're reducing demand until you get to the point that demand actually collapses. And recovering from that is really hard because when demand collapses, it means that people are literally saying, I don't have enough money to feed my family. How that works out is really hard to know in advance.
It's funny, Michael. It was somewhat epiphanic for me because I just sent Lynn Alden's tweet here in the nest. And as we've seen this dynamic flesh out over the last few weeks and months, it's become quite clear that these rate hikes are not doing anything to stop certainly topside demand. And then it's sort of accentuated by the fact that not lower end, but the blue collar jobs that are high wage and they're in higher demand, these people aren't losing their job. There's a stark and pronounced shortage of these types of laborers. So you're seeing some of the efficiency return to the mega cap tech companies, and so they're cutting headcount. But as you already alluded to, the median severance package at Google's $275,000. I'm not sure what the time frame of that is on the payout. But
I believe the minimum is 3 months, and then it extends for each year of service.
Okay. Yeah. So, the reality is these people aren't going to be hurting, right, and panhandling anytime soon. But to sort of finish the question, it like I said, it was epiphanic because for me, when I'd been pondering this recently, and then Lynn Alden put out this little meme, and I realized, well, listen, you're not killing demand. All you're doing is driving the price up for goods that people are still willing to pay. So, and you've heard these dialogues that have happened on TV where you heard a lot in 2020 and 2021. And then through 2022, it was, well, how long can companies get away with it? How long can they raise prices? At what point does demand start to drop off? And even still, a great example, you had John Deere report a blowout quarter this morning. Caterpillar reported a phenomenal quarter. a few weeks ago. And that's just insight into some excellent industrial companies. But nonetheless, you're seeing a lot of these companies, even now, you know, the drop off in demand on aggregate, or at least in profitability as per corporate earnings, yeah, you're starting to see that decay. But in terms of raw demand deterioration, you're not really seeing that writ large in the American economy. So maybe not as much a question as much as, more so a general response to our audience coming from someone with a much more limited understanding than you, trying to contextualize some of the things that we've seen here. I'm not sure if there's anything in there that you maybe want to focus on in response.
Well, so just very quickly, I mean, I think that's a perfect illustration, right? When you talk about Caterpillar, you talk about Deere, right? They're reporting record quarters. Is tractor demand and agricultural equipment demand at record highs?
Seemingly not.
No, it's nowhere close. Nowhere close. All right, so how are they reporting record profits?
I'm sorry, I didn't know if you were going to answer the question.
No. Well, it's a semi-rhetorical question because you already know the answer to it, right? There's basically two tractor manufacturers, AGCO and Deere, and they've decided they're not going to compete on price. They're not going to compete for volume. What they are going to try to do is load every single tractor up with every possible option that they can. And then when a farmer shows up and says, well, I don't really want that, they say, well, that's too bad. What are you going to do? Go buy a tractor from somebody else?
And so does this exacerbate that? That sort of remains my question. Well, but I think we can tie this in, Michael, to the question I posed to you earlier. You've got a lot of companies and their balance sheets are deteriorating rapidly, and they have had to cut. Every day now you just can play pin the tail on the donkey of a Russell company. 20% of the workforce laid off on a daily basis for seemingly the last 6 to 10 weeks. And then we discussed some of the labor dynamics, and I'm just talking really conceptual, general here. I don't know anything about all this, but I know enough to frame questions. It's very interesting. So I guess to try and tie this to a question, how is it that we see blowout quarters from some of these leading industrials? Some of the mega caps holding up well. We'll see what the profitability looks like with some of the capex pullback, some of the headcount reduction. Why is it that we see that on one end? We see some American consumers are, in many respects, in the strongest position they've been demographically, in terms of the broader demographic they comprise, than in several decades. And then you have the, certainly post 09, post 08, post 09, that demographic of consumer and economic participant is at their weakest. So is this a trend shift that we're witnessing? Is this a one-off thing, or is this something that the Fed is trying to rectify, or is it something they're trying to engineer? I don't have the answer to these questions. It's not rhetorical. If I'm off base on any of that, please correct me. But would love some elaboration from you if you're willing.
Well, just to be clear, like anything I say is my opinion and worth exactly what you're paying for it, right? So first, I think the Fed actually has the best of intentions. I genuinely do, right? Now, I happen to disagree with their methodology, and I happen to strongly disagree with the approach that they're taking. But that makes me at odds with the Fed as compared to being right. So I just want to emphasize that this is my opinion, doesn't even necessarily represent that of my employer, et cetera. One, I think the critical issue is that we just have bad data, right? So the Fed is relying on the JOLTS data. I assure you that Jerome Powell is not digging into the details of how the job opening and labor turnover surveys are collected and how the response rates have deteriorated and the implications that has for the data that they're receiving. Likewise, he's not digging into the methodology to understand that a substantive shift in the way that jobs are posted away from things like help wanted ads in newspaper, where you have to continually pay to post the opportunity and therefore you're less inclined to keep it going on a continuous basis, versus systems like Indeed.com, the online listings where you only pay when you accept an application or hire somebody, right? So like it's an actual change in technology that has changed companies' propensity to put low search intensity jobs out there to be hired for, right? It's also unclear if they're fully adjusting for jobs being posted in multiple locations, et cetera, et cetera, et cetera. I assure you, he's not digging into that, nor would I expect him to, right? I would expect somebody on his research staff to do that for him. And in fact, they have. The Dallas Fed has done significant studies on this and says, hey, guess what? That's total bullshit, right? But the downside to that is Jerome Powell listened to the research staff in 2021 who said the inflation was going to be transitory, turned out to be largely correct, but not correct fast enough for his taste, right? And I mean, I'll tell you, I have this argument with my partner Harley Bassman. You know, when I said transitory, I was very explicit and said past the end of 2022. And by the way, I seem to have been too early on that, so I'm equally as guilty of this as other people. But the Fed didn't come out and specify what they meant by transitory. Apparently, most people thought they meant a couple of months at most, right? So 2 years of inflation was apparently far too much. And so they began hiking interest rates, which in my opinion has actually now exacerbated conditions and meant that we'll have a prolonged period of inflationary fights. The second thing that I would say is that their mental models are different than mine, right? So the dynamic of the relationship between consumption and interest rates is what's referred to as the Euler coefficient, spelled E-U-L-E-R, but pronounced like an oiler, like a well driller. The hypothesis is that the Euler coefficient is positive or is negative, right? So higher interest rates drive less consumption because people theoretically can defer consumption and make more money. Unfortunately, every piece of evidence, empirical evidence that exists out there says it's the exact opposite. Higher interest rates actually drive more consumption. There's a variety of reasons why that could happen, but what is not in question is that the coefficient between production and interest rates is sharply negative, right? So investment and consumption and production is sharply negative. So what we're actually doing is we're shrinking the productive capacity of the United States. And that's explicitly what you're seeing, right? The number of restaurants is falling. Even though the demand for restaurants has quote unquote risen, right? The number of manufacturing firms, the number of the industrial production in total for the United States has been falling. One of the scarier charts you can look at is the industrial production of the United States, the IP index. I think I may have posted it at some point in the past couple of weeks. But that's been static for almost 20 years now in the United States. Right? We have not grown industrial production despite the fact that we've become one of the world's largest oil producers over that time period. It shows up directly in industrial production. This is unmatched in our history. Nothing like this has ever happened in the history of the data series. Right? Why is that happening? Because in every possible way, we're encouraging people not to produce. Right? We need to do the opposite. That's why I encourage people to go read the Truman State of the Union speech from 1947. It's really straightforward. We need to produce more to meet the consumption objectives of individuals and households, not restrain their demand. So all of that's just a very long-winded way of saying, like, I just think their models are wrong. And unfortunately, their models are incredibly defeatist, which is, I think, the general sentiment that we have as a society. And it's the only thing that allows me to speak with such negative tones, but at the same time be incredibly hopeful for a world in which my children inhabit, because I know we can do better. I know we can do a lot better. We just need to change the way we're operating.
It's very interesting. There was a follow-up question that I had that, it was something you noted, and I really wanted to press you for it, but then, you continued on with something I was happy to listen to, and I know the audience was as well. It's interesting, Michael, because in many respects, like, I think a lot of the things you're saying sound, at least in a surface level, somewhat positive in terms of the general state of the U.S. economy. But I guess you really are an extreme skeptic in regards. Oh, no, here it is. You know what? Because I was just kind of making something up on the fly. This is what it is. You talked about the IP index. So I wanted to ask you, I asked our friend RJR Capital, who's a pretty frequent guest of Market Talk. I asked him about, and another guest who's been pretty frequent recently, which is Ross Hendricks, who's a macro strategist. The Philly Fed, I heard you lamenting them about their like labor data on your space that I've referenced a couple times 3 or 4 weeks ago that you ran, and maybe it was a little bit longer than that. But the Philly Fed Manufacturing Index yesterday, the expectation was roughly negative 8.5, and it came in, I think, negative 24.7. Let me ask you, okay, so obviously we can all infer, okay, that's a miss, right? That's bad. There's a slowdown in manufacturing activity. But materially, what does that actually look like? What do those 16 and change basis points represent? To any degree you can discuss in the real economy, in corporate earnings, in, even inflation, what does that 16 basis point miss mean?
I mean, I don't think you can relate it quite that directly, but it just tells you that the narrative that currently exists is that the economy is strong because things like unemployment claims have not yet turned up markedly, right? That's just wrong, right? I mean, I told you why. No, we're not firing construction workers yet, although that's coming. No, we're not firing retail workers yet, although that will come when companies like Nordstrom's and others likely go out of business. These changes will happen. They're just happening much more slowly than they did in prior cycles. Instead, what we're seeing is workers being laid off for whom there are effectively no support systems other than the corporations offering them things like severance. Right? I mean, a $450 a week for 26 weeks unemployment check from the state of California is certainly better than a sharp stick in the eye. I'm not complaining about it from that standpoint. But to the Google employee making $275,000, it might as well be a sharp stick in the eye. Right? They're just not going to take advantage of it until they're reduced to truly desperate measures by their standards. And again, I fully appreciate the world's smallest violin is playing for 26-year-old, marketing managers laid off from their latte sipping jobs at Google. But the reality is that those are individuals that consume that are now facing, conditions that they never imagined themselves in the same way that we saw these dynamics for layoffs at Kodak or, Dow Chemical or General Motors in the 1970s. By the way, I'm about to post the S&P Gap earnings, just so you guys can actually see that it's already falling. So I mean, that's just totally consistent with the Philly Fed data that suggests, in all candor, that we're already looking at a recession. It's just not showing up in things like unemployment yet, which are, tend to be lagging and very much subject to revisions. The Philly Fed that you're specifically referring to, you had that, and then the other really important thing that came out from the Philly Fed is they tried to do a more real-time analysis of jobs, and what they saw in Q2 of 2022, instead of the 1.5 million jobs that was reported by the BLS, their initial number was 10,000. The BLS has subsequently revised that data. It turns out that it was negative 275,000 jobs in the second quarter of 2022. We'll see all the other data sets revised lower as well. A lot of the strength in the economy that we saw in the last part of last year, and I'll try to post this. As well. Is a function of oil prices falling so much that they actually dramatically returned spending power to the American consumer. Right. So if you look at the median household's gasoline expenditures as a percentage of their disposable income, for the median household, that was almost a 200 basis point improvement. That's a huge increase, right? I mean, remember, that's equivalent to the total savings that we're experiencing on a system-wide basis right now. So a lot more money went back into people's pockets as gasoline prices fell. Now they're seeing those gasoline price gains being lost to all sorts of other areas. And eventually they'll be lost to unemployment.
What do you think about oil? Do you think structural imbalances can send it higher now that the SPR's been drained? Do you think the administration gets an opportunity to refill sub 70? Do you think OPEC puts a floor on it? Just asking, just out of curiosity.
I mean, to be 100% transparent on this, and I wrote a Substack piece. You guys can access it through my Twitter.
Oh, Michael, before you continue, here these last 10 or 15 minutes, you've had a little bit of audio cutout, not cutout, but almost like your thumb is maybe over your speaker or whatever device you're.
I literally just realized that, so thank you.
No worries.
You are 100% correct.
No worries.
So I just posted the S&P EPS and gap terms into the thing. I'm going to put up the spending one. On the oil front, I think this is one of these frustrating experiences where both sides are quote unquote right. We absolutely need to go through a transition period away from fossil fuels, not because I'm worried about global warming or because I think fossil fuels are inherently evil or because I think that people shouldn't be able to eat as much food as they'd like to be able to eat. But simply because we're not ready to do alternatives, right? We've failed to invest in nuclear. We've failed to make the appropriate investments in things like deep geothermal, et cetera, that could have removed some of our fossil fuel restrictions. And instead, we basically decided, okay, we're just going to, not heat our homes, right? Which is obviously a silly idea. It is disingenuous of the oil and gas space to argue that the reason that they have underinvested is because of ESG. That's just total crap, right? I mean, we had negative oil prices in 2020. We had oil prices collapse in 2014. What you effectively have had is a shareholder revolt against further significant investment. And that's leading to explosion in the margins associated with oil and gas and in underinvestment, again, consistent with an industry that has quote unquote learned its lesson. The offset to that, right? So overall, that's bullish and creates conditions under which you could have spikes. The flip side of that, though, is that on a global basis, I am incredibly skeptical of stories like China dramatically increasing its oil consumption. Will they increase their oil consumption? Yes. Do they now have mechanisms for feedback from oil prices going up they didn't have in the lead up to 2008? Absolutely. And people forget that prior to 2008, gasoline prices in China were pegged and not subject to volatility around oil prices, right? That changed in June 2008. When that changed and gasoline prices in China rose significantly, global demand collapsed. That was the start of what happened in 2008, right? Now, the vast majority of EMs do not subsidize gasoline consumption. And as a result, as prices go up, demand falls much more rapidly. It's much more elastic in its demand structure than it was historically. And I just think that most of the oil Super Bowls are ignoring those dynamics.
Yeah, with oil, it's been a tricky one because you get a lot of the headline news, right? And of course, some of the geopolitical tensions and certainly OPEC is seemingly souring on the West, particularly the United States. And so you hear this, you hear talk about this game of cat and mouse is being played and, not allowing crude to breach 70 to the downside. And, Biden's been very public about where he wants to refill the SPR. I do wonder, though, Michael, what kind of my thing is, okay, well, if demand is going to remain strong, I think, oh, no, you're fine. I think we have to probably bifurcate the question and think, number one, for how long? And then what does that mean for, the airlines blow out earnings? People are traveling, whether they're traveling or not on credit cards. It doesn't matter how they bought the tickets in the fourth quarter. They still bought the tickets. So, nonetheless, we have oil that remains fairly low. So it's like, for me, I have found it challenging to derive any sort of bias from it, because especially in late December, early January. In late December, early January, it seemed like oil and commodities were pricing in kind of like imminent recession. And then throughout the rest of January and February, now oil's bounced some, commodities have bounced some, but there have been, the markets bid euphorically and in a frenzied manner because, oh my gosh, no recession, yada yada. Now we're seeing what no recession means in regards to inflation, remaining stickier than expected. Certainly, the 2% by summer thing, that's obviously no longer seemingly no longer a credible, postulation to put forth. So with oil, I don't really know. I mean, when I say I don't know, that's not me as a scholar saying I don't know. That's me as, for lack of a better word, an idiot who genuinely doesn't know. But I do think it's interesting that despite all this no recession data, where's the move in oil been? Blowout airlines quarter. All right, where's the move in oil? Strong guys from airlines. And that's just one observation. But it is interesting. It's not making a meaningful move that reflects sort of strong economy for the rest of the year. But then conversely, you're not seeing it make that move from a structural imbalance framework either.
Yeah, I mean, as I said, my focus on oil is more on the demand side. There's people who are far more talented and skilled than I on the supply side. We typically refer to them as barrel counters. Guys like Pierre Anderon, et cetera, are going to be infinitely better than I will be in terms of telling you what the dynamics of oil supply are. The blind spot for them, of course, is oil demand, and that tends to be where the more traditional macro overlaps with the commodity. It's not uncommon for me to interact with people who are in the commodity space, turning to me and say, well, what's your forecast for demand, right? What I'm highlighting is something slightly different, which is the last cycle we had in oil, there was very little feedback because most emerging markets continued to try to subsidize oil, if not in absolute level, certainly in terms of the volatility of prices, right? They didn't want to experience high volatility in oil prices. And as a result, for their population, because that tends to be destabilizing to growth, and so they tended to shield them either by capping oil price increases or gasoline price increases, or by pegging them at fixed levels for periods of time, et cetera, right? So they didn't have free markets in those types of products. Post 2008, that fiscal capacity and monetary capacity to manage those assets in that way no longer exists. And as a result, most emerging markets have something close to direct pass-through of price increases on oil, energy, other types of fuel, et cetera. That means that the demand side of the equation can respond faster, right? Like when we talk about price inelasticity or elasticity of demand, what you're typically saying with oil is that it's highly inelastic. In other words, price can go up a lot before it destroys a lot of the demand. That's unsurprising, right? Oil is a kind of baseline thing. It's like, at what price would you stop breathing? Well, the number's pretty high, right? As much as I hate to admit that I'd be taking advantage of, I'm not going to stop breathing until I basically run out of money and my ability to pay. That was explicitly true if I don't have to pay any more for it, even as the underlying price is moving, because the government is shielding me from that. Taking that away just means that it's going to be more elastic. We will see more of a demand response. And that, by the way, that's exactly what we've seen, right? That's why oil prices have not skyrocketed, et cetera. We've actually seen oil inventories build in a relatively unanticipated way, precisely because people are consuming less. Now, you hit on the airlines, and that's always an interesting one. Just remember with the airlines that there's a huge difference, again, just like deer, between airlines reporting record or very high levels of earnings and the actual quantity of travel, right? So what we've really seen in this cycle is an explosion in private travel, right? People deciding that they're going to, hire the citation 10 and fly their family private or their business party private as part of their social distancing bubble, the utilization of those types of aircraft has exploded because you need the same number of pilots to fly a 10 passenger citation jet as you do to fly a 747. That means that there's far less pilots available to fly normal people, right? And that shows up in the data. We see it very, very clearly. Payroll employment in air transportation is off the charts. The number of passenger miles from commercial flights is down. It's not up. It's down from 2019.
Michael, I guess if I could, you'll have to forgive me for after this discussion for posing such a, for lack of a better word, primitive question. Given your outlook on all this, if we want to talk about a takeaway, what do your portfolios look like? I see, you work in wealth management. I mean, are you postured defensively given all the, are you short credit? Are you long treasuries? What's your outlook for equities? I'm not asking for price targets. I'm asking at a conceptual level. What does this look like for you? Our whole discussion here, this last, 60 to 90 minutes, how do you extrapolate this for your personal portfolio, and what needs to change for you to make changes?
So look, first of all, I could be accused of talking my book because I am long rates and I am long rate steepeners under the expectation that the Fed is ultimately going to have to bend to the markets as compared to the markets bend to the Fed. Right. So I just want to be clear. I'm not part of the camp that says, the Fed is going to pivot because they want to. I'm saying the Fed is going to pivot because they are forced to. Right. Nobody decides to change their mind voluntarily in that framework. That has been the wrong call on a year-to-date basis. Now my portfolios are up because of the way that I construct them, but I'm lagging behind the S&P, so I'm not going to pretend that I've got the right answer at this point in time. But in general, that does put me in a position where I am favorable towards the front end of the bond structure. So I am long 2-year bonds. I am long steepeners because my concern is that even if I'm correct about the front end and that the Fed is ultimately forced to cut, the level of response that I need just to simply straighten out the yield curve and get the 10s above the 2s is enough that I don't really see any reason to be outright long 10s, right? I am short credit in 2 separate flavors. One is through a discrete portfolio, and the other is through a single name that I think actually has really interesting characteristics in the credit space. I'm not going to mention that name, but if you look at some of the portfolios I own, you can figure that out pretty quickly. I will always carry some long exposure to the S&P, although I carry that in the form of in-the-money call options, so that it is a relatively efficient utilization, and I'm limited in terms of my downside participation while having a positive Vega component to it, long volatility component to it. And then, the majority of the rest of my portfolios are in one form or another tapping into other simplified products, everything ranging from our vol harvesting strategies, which we run as what's called a capped variance program, and our CTA trend following product, which actually is more favorable to the inflationary thesis than anything else, right? It's a full acknowledgement that prices and behavior anywhere they want. I think the thing that a lot of
Michael, we're having the muffle right now. Yeah.
So the one thing that I guess I would highlight about people who got the bond call, myself included, wrong last year, and I largely corrected myself around the middle of the year. I actually wrote a piece saying, look, Powell has to stop, but he's not going to stop. It is that the Fed can do what the Fed wants to do, right? Those long and variable lags in many ways prevent it from being forced to face the ramification of the choices that it's made and they'll hike until they break something, and then they'll say, well, we couldn't possibly have seen that coming, right? It'll be disingenuous, it always is, but that's the way the cycles work. I was candidly very surprised that they chose to ignore the plans, and this is on me, by the way, I should have known better. The plans and understanding that has been put in place post Volcker about how you handle episodes like this. They basically decided, no, you know what, we're going to go back to what we think worked under Volcker and do exactly the wrong thing in my analysis. That makes me wrong. That was the easiest way to put it. But to answer your question, my portfolios are positioned conservatively, and the kind of biggest bet that I have right now is actually structurally against things like credit spreads.
And I assume that's a derivative of the fact that you think the Fed will be forced to pivot, by some sort of credit blowout.
Yeah, I mean, I think that credit spreads will blow out first, and then the Fed will be forced to respond. But in the process of getting there, you'll see bonds work.
When you say you're long the front end, does that mean you're long the 2-year in anticipation of it decreasing? Just to make sure I understand that correctly.
So I'm long the 2-year for two reasons. One is I think that it offers optionality to them decreasing, right? And that's even more true today, right? I actually had just reduced some of my positioning. I'm starting to add back to it. Fortunately, I managed to get that done ahead of the most recent price moves. But it also provides me with, a pretty attractive yield to wait, right? So 4 and change percent to sit and wait for some of these things to play out with 20% of my portfolio. I'm not getting killed, right? And in a lot of ways, holding that cash provides me with tremendous optionality if my other forecasts are correct. And if they're not correct, then it also is not really killing me. I've got ways that I can continue to participate, but I can be wrong with a pretty high margin of error.
So, if the whole sustained rate hikes, like now I see the forecast, last I saw it was a 43% chance of an increase in June. You're not particularly affected if the 2-year ends up going above 5, and you think ultimately it's just at 0 or 0.25 probably at some point, or at least 1 later on in the year. Is my interpretation there correct?
Well, just remember, when you say the 2-year going above 5, one, if you're talking by going above 5 you mean 7, then yes, I'll get hurt, right? There's no question around that. But the duration on a 2 is really not that high, right? And the coupon on it is attractive enough that I'm being reasonably well compensated while I wait. If it happens a year from now that 2s are at 7%, right? Will I have been unhappy with my choice? There's no question in my mind. I'll be unhappy with my choice. I will have lost money on the trade. But is it going to be a catastrophic loss, something that I can't recover from? No. And so I'm okay taking that. I mean, again, remember, we're now at 462 on 2s. We're sitting, basically back at the highs that we experienced last November. And yet it's happening, that is happening in, just to put it into, more traditional terms, it's happening with divergences on things like RSI, et cetera. The momentum on the bond short is failing. Right. So as we potentially push to new highs in yield with momentum lagging, that tends to be an indication that you want to be on the other side of the trade. Right. In other words, betting on lower yields.
But your standpoint on lower yields is from more of I guess
it's a credit story. Right, I mean, the economy will. I have to be right about the hard landing scenario for my portfolios to really benefit from that positioning.
And so, you think this hard landing is sooner? I mean, like what? I'm not asking you this from the standpoint of, hey, Michael, let me know so I can get my shorts in or whatever. But you think this is sooner than later? You think this is a 1H versus 2H type thing?
I think that before we are through 1H, it is going to become increasingly clear that the economy is much weaker than people think. whether that manifests itself in pricing before the second half is clearly up in the air, right? Markets increasingly don't represent discounting mechanisms for all the reasons that you've heard me talk about before, right? You just mechanically have money that is being added into the system under the framework of if you give me cash, then buy, right? And that's true in bonds, that's true in equities. I think we see a lot of evidence for that sort of behavior. But if people start losing their jobs and contributions begin to fall to 401ks, then my concerns grow. And particularly if those, in the kind of 55 plus category start losing their jobs, which I anticipate is going to be the next real area, then things can get ugly very fast, because that's a group that saves a lot of money, right? Their kids are typically already out of college and out of the home. They're in that final push to save for retirement. If they're cut out of the system, that becomes very ugly very fast.
I've thought I've waffled back and forth with the bond trade. At the beginning of the year, I tried to put on some TLT exposure, which is just my best way to access it on a brokerage. I had some exposure temporarily, not with meaningful size for my portfolio, but I parted with it pretty quickly, and I've been right to do so, because even options for 2024 are down 60% from where I cut them. My thing is with Michael, I guess, please correct me if my interpretation of your positioning is wrong. But from what I understand, you're basically saying you think things are on the cusp of deteriorating pretty rapidly, and you start to see the bid. You start to see the long bid, and whether or not in the short term this is conflated with declining inflation, that appears to have been dispelled over the last few weeks. But regardless, you think we see the pickup in yields that eventually will be understood as people started to recognize the economic deterioration was real. Am I summarizing your stance on it correctly?
Yeah, I think that's a reasonable interpretation of it. Again, I would just emphasize that, like, if you go back and you look at the fourth quarter of 2018, you saw similar behavior. You also saw similar behavior in 2006, I believe it was. The Fed is really serious in what they're telling you, right? They actually believe what they're saying, and they are not acting in terms of their desire to fight inflation with interest rates, right? They're legitimately telling you the truth. That doesn't make it right in my models, and we just highlight again. You can take a quick look at this picture that I'll put up, but the technical picture on twos to me is actually quite bearish. I could be the only person on the planet that sees it that way, but the last time we were up at these levels, all I remember hearing from people was, if 10-year rates go above X, then the bond bull market is over, followed by rates going to the lowest levels in history. Alex Gurovich, another good friend of mine, thinks fairly similarly. Like, we're running 135% debt to GDP. The behavior of Powell is meaningfully impacting the fiscal capacity of the United States, and yet he has the gall to label himself the fiscal agent of the Treasury in his speeches. I'm sorry, you don't tolerate it that long.
And you think they're just going to force this? I don't know what a credit spread blowout consists of, but it's been so interesting that recently, there's up until a few days ago, and it was on the soft landing narrative. I thought it was comical, but there was the bid for sub IG and the bid for junk and the bid for high yielding bonds. And they've held up. Granted, we're talking here like the last week, week or two, but they're holding up relatively better than just, standard U.S. treasuries, which I thought, to me, this is just even this week, you look at the market, the Russell's up, the Russell's leading. Super speculative tech is leading. Carvana's 5xing in a day. This type of Upstart putting in a 30%. I know what a short squeeze is. I'm not under any illusion about this type of action. But for me, the bond dynamic I thought was particularly noteworthy, because you have treasuries selling especially long duration, selling on inflation, fears, a resurgence, expectation, whatever you want to call it. And then you have a bid for junk bonds at sub IG because basically, oh, hey, recession avoided. We can buy corporate credit. I'm not very smart, but I know enough to laugh at that. And I imagine you did too.
Again, you've listened to enough of my stuff to hear me say the phrase, we're a narrative species, right? For thousands of years, we believe, and we have a need to explain things, right? Why does the sun rise in the east? Well, you see, there's this God, and he has this golden chariot and these fire-breathing horses. And every day, for some reason, this God has to show up at work and drive the chariot across the sky, right? And that's what the sun is. That's why it rises in the east and sets in the west, right? Does this God get healthcare benefits? We're uncertain. But these are the stories we tell ourselves. We believe them for thousands of years, right? Why are credit spreads tightening? Well, it must be telling us X, right? It's crap. It's, market positioning got off sides. People got too confident in their ability to short junk. And as people basically looked at their portfolios at the tail end of last year and said, okay, well, I might as well make lemonade with lemons. I'm going to take my tax losses. I'm going to sell down these things. And then as I come back into the new year, I'm going to rebalance my portfolio to a certain extent and add back just a little bit into, add back some of the positions that I had in the disruptive tech or other stuff that I thought really had value. Bitcoin as an asset class, right? I'm going to go back to my 2% allocation to Bitcoin. Well, in an environment in which nobody is really going to sell because the person who is holding Tesla at $100 down from 400 isn't suddenly going to say, boy, at 120, that's suddenly really expensive. I'm going to sell it back to you, right? Nobody involved in the trade is looking at it that way. You experience extreme inelasticity, and on the attempt to rebalance, the prices can explode, which in turn causes people to create a narrative for themselves. Well, there must be something good happening at Tesla. Look at the fundamentals in Tesla. Nothing good is happening. Nothing good is happening, yet the stock has doubled. Right? Why? Because it's an inelastic stock. Those who are long it aren't going to sell on valuation. They're going to see rising prices as telling them that their analysis of Tesla is clearly right, and the rest of the world is just about to beat a path of pure admiration to their door to say thank you.
It's funny, Michael, because our regular listeners to Market Talk have heard me reference this before, but my dad's best friend, they're UPS pilots. And my dad's best friend put 80% of his 401k, and I probably Q2 of 22, of course, in Tesla, and his average price is 275. And he was really panicking. He's a family friend, and so I was bearish basically the entirety of 2022, and my dad and I did well playing downside. Yep. And he's buying Tesla. My dad's friend, he's buying Tesla, loading up. My dad's friends are laughing about him about all the cheap shares of Tesla and DocuSign and ARC and all the free. Of course, they're calculating like oh my gosh, I'm getting a 5x back to all-time highs. I mean, kind of how the standard participant functions in markets. But then, of course, at 100, he's calling me and he's like, Carter, how do I hedge or whatever? I'm like, look, don't sell it at 100. You're going to get a bounce here, to some degree. And I was telling him at like 130, 140, I'm like, listen, man, you got to start making some decisions. But then, of course, and he didn't. And then, of course, now above 200, like he bought the pullback on the 365,000 vehicle recall yesterday.
Oh my God.
He's just convinced it was just and there was this guy, this big account, the Tesla called on FinTwit is really, really astounding. But there was a tweet yesterday and a guy said, can't believe they're letting me take it 5% off. Of course, no caveat that stocks doubled in 3 weeks. And he's like, I'm buying this dip or whatever. And yeah, from a fundamental standpoint, from a moat standpoint, the Tesla picture is self-evident, but here's you said it. It doesn't mean that the stock can't go up. But for 2023, with the dynamics that were still relevant in 2022, that manifested in 2022 that are still relevant now, and arguably they're more acute now. That's my opinion on Tesla. It's probably worse to own Tesla now in 2023, in my opinion, than it was in 2022, because I really think when you start seeing the downside, you're not really going to see a company like Tesla, a discretionary mega cap, be a beneficiary of these kind of bear market rallies and stuff. It was down only in the fourth quarter. Capital went to Caterpillar. Capital went to United Health Group, whatever. So I'm sure we, have a relatively confluent outlook on Tesla, but this is just a sort of a testament to the psychological aspect that you alluded to, and it's like that Helen Meisler tweet, nothing drives narrative quite like price, and it's been a remarkable dynamic, and ultimately for me, reaffirming and sort of my higher time frame conviction, that we do see lower prices, because you've seen the shift these last 3 or 4 weeks. People are I say this a lot. They're looking left, they're looking right. They're saying, yeah, maybe, it's, I guess maybe that old yield curve thing is inverted, but ultimately, the retail sales came in better. So there's no recession, and God damn it, Tesla's down 60%, it's time to buy. And it's a very curious dynamic, and on lower time frames it can work, but the issue is that the people don't sell until we go a lot lower. So,
yeah, the issue is, in all honesty, that they some fraction of them will never sell. Right, they'll ride it all the way to zero. But I don't think the issue is Tesla's down 60%. I think the issue is Tesla's up 100%, and God damn it, I missed it. Right? It was obvious. Clearly, those guys calling for a recession are morons. All of those who were saying that Tesla was, going to zero at 100, look how wrong they were. Right? And therefore, this 5% pullback, this is my chance to get in, just not at the all-time, just not at the high. I still want to be a value investor, right? I've learned my lesson. I'm going to be thoughtful now, right? That's the way these things play out. It happens every time, and it really is like, we are a social species. We can't stand to be left behind. And by the way, I can't believe I'm having this conversation with a guy who has Bitcoin in his name.
I'm just a show host. We've got other guys on our team who, are more crypto focused. I'm definitely more kind of a macro equities guy. I don't own $1 of crypto right now, not Bitcoin or crypto or anything. My, position disproportionately for downside on a higher time frame. I mean, I'm bullish on Bitcoin in the long run. I think it's a beneficiary of a commodity surge. I think the inevitability here is probably money printing. I think Bitcoin presents a better option. Not necessarily as the entirety of your portfolio, but in a, fairly rapidly deglobalizing world with deteriorating growth prospects and just demographical shifts in terms of young people and what they're interested in. We saw this dynamic, amplified in 2020 and 21. Younger people have an appetite for a hyper speculative investment profile because they can't afford basic things. That's not me coming in with my center left, like whatever. But it's just a reality. If you just go talk to young people, they all want to own Bitcoin. They're going to want to own Bitcoin when they're 30. They're going to want to allocate their 401k money for Bitcoin. So even though from a fundamental standpoint, I think Bitcoin deserves a higher valuation than where it stands on a long enough time frame, it's more so me and as a participant in a trend shift that I do think from a purely demographical standpoint, in addition to, I think, the macro themes that in my opinion, which isn't worth a lot, but it's an opinion nonetheless, I think is probably an inevitability, and why Bitcoin will make sense moving forward. To be clear, I always say this. I think I can't even say the phrase with a straight face. I work for because Bitcoin. I'll say this. I'll say it now to 800 plus people. I think hyper Bitcoinization. I literally can't get it out without laughing. I think it's one of the purely dumbest things I've ever heard in my life. I think it's insane. I think those are the people who, I joke about this a lot. Those are the people who backed the truck up at 50K in December and January, and they couldn't believe they could get it 30% off. I like Bitcoin a lot, and I think there's a place for it. But don't get it twisted. You're not speaking with a guy who thinks we're going to be paying for a Friday night dinner with Satoshis. So,
well, the if the demand for it is being driven by demographics, the only thing I can tell you is just that thank goodness they're not making that many young people. So, anyway, definitely don't want to get into a discussion on Bitcoin. Thoroughly enjoyed this.
No problem at all, man. No problem.
Thoroughly enjoyed this. This was great. I've been here forever. Didn't really plan on doing this, but heard George come in and comment on some stuff and had some free time. So glad we were able to do this, and appreciated the opportunity to meet your audience.
No, hey, thank you so much, Michael. Thank you so much. It was absolute pleasure having you on. And again, my name's Carter, host of Market Talk. It was so great to have you. Our community was enthralled by your appearance, and so thank you so much. I'd love to connect with you, maybe talk with you at some point in the next couple weeks, months, whatever. If you've ever got time, if we could ever get you back on. This was outstanding. I really enjoyed this, and so yeah, thank you so much for coming on, man. I hope you have a great evening and a great weekend.
Thank you very much, Carter. I appreciate it. Feel free to send me a DM.
Awesome. Yeah, thank you so much.
All right, take care.
Yeah, no, thank you. So big thanks to Michael Green for coming up. Really just a phenomenal conversation. Our Because Bitcoin community knows, if you're here in our Discord, which I'm going to send the link to, by the way, for those of y'all who, it's a free Discord, by the way. Really outstanding conversation here with Michael Green. And just kind of to recap, we talked about labor, wages, rates, bonds, macro. We talked about everything there is to talk about. So just, to repeat myself, an outstanding discussion. I'll say to our audience, if you're here for the first time, my name's Carter. I host Market Talk Monday through Friday at 4:15 Eastern, shortly after the equity markets close. So we have guests on, we have guys like Michael Cantrell up somewhat frequently, our friend RJR Capital, Trader XO, lots of great macro people, equities guys. That's really my focus, despite the name. We've got other show hosts who host kind of more crypto-centric stuff. So listen, guys, if you liked what you heard today, like I said, we have lots of these great discussions. Today was absolutely phenomenal. But just give us a follow, if you'd like to keep up with us. As I said, host the show every weekday shortly after the equity markets close. So I'll go ahead and wrap things up here. We've been going for almost 3 hours, but just a phenomenal discussion. And thanks again so much to Michael Green for coming up and giving us a part of his Friday evening. Just really great stuff today. So anyways, I wish you guys the best weekend. We'll be back on Tuesday. We won't be doing a show Monday because the equity markets are closed. And again, you could just follow us and keep up. And once again, a big thanks to Michael. Hope you guys have a great weekend. So thanks, everybody.